Hello and welcome to session 13 of the Basic Tax course. We're going to begin session 13 with a review of the session 11 quiz answer key. I have up on the screen in front of you a copy of the session 11 quiz. We're going to take, as always, a look at the most frequently missed questions, beginning with question number 2. Deductible miscellaneous expenses subject to the 2% of AGI limit could include broker's commissions paid in connection with your investment property. No, broker's commissions would add to or subtract from the broker's commissions would actually add to your basis in the property, but they're not deductible. Investment-related seminars, no, the IRS specifically goes out of its way to say those are non-deductible in Pub 17. And professional accreditation fees paid to enter a new trade, that's a big exclamation point, no. Again, Pub 17 says absolutely not. Finally, dues paid to professional associations, are those deductible subject to the 2% limit? Yes, they are. So an example of trade associations would be if you were a doctor, you might belong to the American Medical Association. If you're an attorney, you might belong to a state bar association. And if you are a registered tax return preparer, you might belong to a tax preparer association. So that is perfectly normal and common and considered ordinary and necessary in many business professions. Question number 4 is the next question we're going to look at. Employment agency fees you pay to obtain a job in a new field are deductible as a miscellaneous deduction. That is again a big false. Again, the costs to enter a new profession are not deductible. The next question in line is question number 11. In March of 2011, John's motorhome was destroyed in a tornado. The motorhome cost him $65,000 and it had a fair market value of $35,000 on the date of the tornado. His insurance reimbursement was $25,000 and his AGI was $50,000. What is John's casualty loss deduction for 2011? Again, you're going to need to look at the information provided in this problem and apply to that information what you know to be the rules regarding casualty losses. There are 2 primary rules for casualty losses in terms of computing the loss. The first is the 10% of AGI rule, and the second is the $100 rule. And then, of course, above and beyond that, we have to determine whether or not there's an allowable loss and how much that loss is. So let's take a look at this again. The home was destroyed. The motorhome cost him $65,000, so that's his cost basis. It had a fair market value on the date of the tornado. So the lesser of his cost or the fair market value, well, the lesser number is the fair market value, $35,000. So we start with $35,000. His insurance reimbursement was $25,000. So we're going to go $35,000 minus $25,000 equals a $10,000 loss. How much was his AGI? Well, it was $50,000, and we now use that to compute the 10% of AGI limit. So 10% of $50,000 is $5,000. We also need to apply that $100 rule. So we take a $10,000 loss, we subtract $100, and we subtract $5,000. That gives us an allowable loss deduction to carry to Schedule A of $4,900, and that, of course, is answer number B. Number 12. Which of the following is deductible as a casualty or theft loss? Now, in our last lecture, I went through a long list of specific examples of items that are allowed and not allowed. And loss of a diamond ring at a sports event is certainly something that would be not unusual. It's normal and to be just out and about doing things and lose stuff. And so it's not considered to be unusual or unexpected to lose something, and that's why A is not allowed. But number B, that was actually on the list of things IRS has said no to. The damage to trees caused by Dutch elm disease, that is a definite no. Then we have damage caused by vandalism, that is a yes. And finally, damage to trees caused by accidental application of the wrong chemicals. That is also a yes, and another example of something that the IRS has gone out of its way to give as an example of something that is allowed. Now, this particular question has answers A through F, and I can promise you that on a government-administered exam, the likelihood of ever being given more than 4 choices is very minimal. It's more my decision as your instructor to test your brain a little by throwing in more possibilities. Is it any one of these options, or is it a combination of those options? And I really wanted to test your knowledge. The correct answer is both C and D, which is, of course, option number F. And finally, another nasty mini problem that I threw at you. This problem involves Donald, who was very unlucky this year, and in September, Hurricane Daisy severely damaged his home. Hurricane Daisy did not create a federal disaster area, and Donald had the following losses. Well, I've given you the assets that were lost, his cost basis in those assets, the fair market value before the disaster, the fair market value after the disaster, and any insurance that he may have claimed. Let's take these in turn. The home has a cost basis of $200,000 and a fair market value before the event of $400,000. The fair market value after the event is $300,000. Remember, the rule is the lesser in the loss in the basis of the property, or the lesser of the cost basis in the property, or the difference in the fair market value before and after the event. Well, the difference before the event from after the event, that's a $100,000 difference. The insurance reimbursement is $100,000, and therefore the loss on the home is actually zero. Next, we have the car. The cost of the car is $30,000, but the fair market value before the event is $15,000. So we're going to start with that $15,000. It had zero value after the event, so the loss is $15,000. But after $10,000 of insurance reimbursement, we actually only have a $5,000 loss on the car. And finally, on the household property, before the event, there was a cost basis of $50,000 and a fair market value of $30,000. So $30,000 being the lesser number is where we start. We take the fair market value before the event, $30,000, subtract out fair market value after the event of $5,000, and we get a loss of $25,000. We then subtract out a $2,000 insurance reimbursement to get a $23,000 total loss on household property. So what is our total loss, or what is Donald's total loss? Well, it's going to be $5,000 of loss on the car plus $23,000 of loss on the household property. That gives him a $28,000 casualty loss. Well, how much is he going to be able to deduct? Let's look at the next part of the problem. In a separate incident in November, Donald lost his prize dog Pluto, who ran away from home and was never found again. Well, the IRS has specifically gone out of its way to say that strayed pets are not a deductible casualty loss, and so the fact that Pluto ran away is not an event that will be deductible for Donald. So the prize dog has a basis before the event of $15,000, a fair market value before the event of $15,000, but zero after. The loss simply is not allowed, and it doesn't matter how much it was. So let's calculate Donald's total allowable loss. His total allowable loss is for the first event only, and it was $28,000. Next, we have to look at his adjusted gross income. And we tell you in the wording of the problem that his AGI is $75,000. So $75,000 times 10% is $7,500, and we need to apply a 10% rule as well. So we take the $28,000 loss, and we need to apply the $100 rule as well. So we're going to take the $28,000 loss, subtract out $100, subtract out $7,500, and we're left with an allowable casualty loss to carry to Schedule A in the amount of $20,400. So I know before I ever go to fill out Form 4684 how much Donald's loss is going to be on Schedule A. It's merely a matter of getting the form to say that. The next part of Schedule A was that he had state income taxes totaling $6,000, real estate taxes of $4,000, and $15,000 of mortgage interest. We're silent on the issue as to whether or not the mortgage interest was on a 1098. You can assume it was in this case. So let's go over and take a look at the finished forms for Donald. And here is Form 4684 for Donald. We can see that we've described each of the properties in turn, the house, the car, and the household property. We've put the cost basis of the home, the cost basis of the car, and the cost basis of the household property in columns A, B, and C. We've also shown the insurance reimbursements on line 3. We've shown the fair market value before the event. We've shown the fair market value of each asset after the event. And then on line 7, we subtract line 6 from line 5 to get the net loss after insurance. And finally, we figure the allowable loss on line 9. The allowable loss carries over at $28,000. We then subtract out the $100 rule. We then enter 10% of the adjusted gross income on line 17 to arrive on line 18 with an allowable loss of $20,400. We then go up to Schedule A, and on Schedule A, we enter the $6,000 of state income tax withheld, the $4,000 of real estate tax withheld. We have net taxes on line 9 of $10,000. On line 10, we've entered $15,000 of mortgage interest, and on line 20, we've entered the casualty loss in the amount of $20,400. Line 29 shows that Donald's total itemized deductions for the year are $45,400. So that concludes the review of the Session 11 quiz answer key. Let's take a look now at the Session 12 homework assignment. So I now have the Session 12 homework assignment answer key up on the screen in front of you. It's down here in the lower right-hand corner of your screen. The problem itself is showing here. Let's revisit the problem again and kind of look at the elements that are in it. Firstly, Spring Days is single, and she has a 17-year-old daughter. 17-year-old means that her daughter is too old for the child tax credit. But she is going to be a dependent, and because she has a dependent who is living with her, she will qualify for head of household. So Spring will be head of household. She has a daughter who is a qualifying child, but the daughter is too old for the child tax credit. Now, during the year, Spring was a half-time student at Washburn University. Well, if you are at least a half-time student and you are not already a graduate of a degree program, you're eligible for the American Opportunity Credit, so Spring is eligible for this credit. Her Form 1098-T shows her tuition and qualified expenses for the year were $1,300. And the way the American Opportunity Credit works is that Spring will be allowed 100% of the first $2,000 of expense she has. Well, her expense was only $1,300, so she will claim 100% of $1,300. Therefore, her credit will be $1,300. And I know mentally that that credit will be split. 40% is going to be a non-refundable amount, and that means her refundable credit will be $520, and her non-refundable credit will be $780. So before I ever even fill out the form, I've got that much figured out. The next step is that it says Spring used money from her student loans to pay the tuition, so her expenses were not out of pocket. The reason I give that information is that many tax clients assume that because they used student loans to pay tuition, or that their child has a student loan that was used to pay the child's tuition, that they don't have any expense. And that's not the case at all. If you're on the hook for the loan and the loan has to be repaid, then the loan is considered to be your money, and you are eligible to claim a credit for money paid for with student loans. Now, if you have a scholarship that does not have to be refunded, or if your tuition was paid for by an employer, those are two examples where you may not claim a credit. But the fact that a student loan taken out that needs to be repaid was used to pay the tuition does not mean that the credit is not allowed. In fact, it does mean that the credit is allowed. Spring had $1,000 of dividend income and paid $300 of foreign tax on those dividends, so she will be allowed to claim a foreign tax credit. However, she is single, so her credit will be limited to $150. Spring's W-2 is attached to prepare her federal return. Now, unless Spring attaches Form 1115, her credit will be limited to $100. If Spring elects to attach Form 1116, it's possible she'll qualify for a higher credit amount than $150, but we're going to leave it at $150. Spring's W-2 is attached. Prepare her federal return. And now looking at Spring's W-2, I did want to point out that she has Box 1 wages of $36,700. And you can see that in Box 12, she has a code D showing $500. Spring's income is low enough that she will qualify for the Retirement Investment Savings Credit, for which she will need to complete Form 8880. So let's pull the answer key up and take a look. So back to that statement on Spring's out-of-pocket expenses, or the fact she didn't have out-of-pocket expenses per se. That's irrelevant. Her education credit will be allowed in full, and as I already described, she's going to be allowed a $780 non-refundable credit and a $520 refundable credit. Her filing status is head of household. And here is Spring's Form 1040. You can show that we've given her the filing status head of household. We've listed her daughter Dora as her dependent. There are 2 dependency exemptions claimed, but the child tax credit box is not checked. We've entered on line 7 that the wages earned were $36,700 as shown on the W-2, and as shown on her 1099 DIV, she has $1,000 of dividend income. Her adjusted gross income is $37,700. Right off the bat, I know she will not be affected by a phase out on the American Opportunity Credit, but she's probably going to be subject to a credit limitation or phase out on the Retirement Investment Savings Credit. On to page 2, her standard deduction for being head of household is $8,500. Her exemption deduction is $7,400. Her taxable income is $21,800, and her tax is $2,666. Her foreign tax credit is $300. Form 1116 is not required because the total credit being claimed is $300 or less. We enter her non-refundable education credit, and we enter her retirement savings investment credit on lines 49 and 50. Let's take a look at those forms. Here is Form 8863. We enter the name of the student, which is Spring herself. We enter her qualifying expense and the total amount of credit that she is claiming. In Part 3 of the form, we figure the refundable portion of the credit. We also figure whether or not Spring is subject to a phase-out. She is not subject to a phase-out because her income is less than $90,000, and her total non-refundable credit is 40% of $1,300 or $520. The difference between $520 and $1,300 is $780, and that is the refundable portion of the credit. On Form 8880, we enter the amount of contribution that Spring made to her qualified retirement account. That was $500. Then on line 8, we enter her adjusted gross income. Her AGI is $37,700, and we find where that puts her on this table. We find head of household. We then go over to her income level, which is greater than $36,000 but less than $42,000. We find the head of household column and see that that is a 10% credit. So we enter 10% on line 9, and we figure that to be a $50 credit. The extra steps or lines on the form are used to figure whether or not she's subject to a limit on her credit based on her tax. Her tax liability from line 46 of the 1040 is $2,666. And her total allowable credits are $760 of non-refundable education credit plus $300 of foreign tax credit. Those two amounts total $1,080, where they're subtracted from the total tax she has of $2,666, leaving her with net tax of $1,586. That's more than the amount of credit shown on line 10, so her credit on line 10 is allowed in full. And again, we have $300 of foreign tax credit, $780 of non-refundable education credit, and $50 of retirement investment savings credit. That's total credits of $1,130. They reduce Spring's tax from $2,666 down to $1,536. She had $1,500 of withholding on her W-2. She also has a $520 refundable American Opportunity Credit, leaving her with credits and withholdings in the amount of $2,020 and a refund of $484. So that concludes the review of the Session 12 homework answer key. It is now time to take the Session 12 quiz. Please push pause on video playback and complete the Session 12 quiz. When you are finished, please resume video playback for the Session 13 lecture. Well, welcome everyone to today's topic, which is federal tax credits for family with children. And in this morning's class where we talked about tax credits for individuals, I told you that credits were one of my favorite topics. Well, actually, one of my favorite topics is really the earned income credit. And that's the topic of today's class. I get a little bit excited when I'm talking about it, mainly because the clients that I've worked with over the years, a good number of them have qualified for this credit, and I've seen how happy they are when they receive it. Of course, I'm talking from the perspective of the Santa Claus syndrome rather than the balancing of the federal budgets and so forth, but I do like the topic. And I'm going to quickly move on to this page right here, and it's really the opposite of this morning's class. This afternoon's class, we're talking about everything in pink, and we're not talking about what is in yellow. So today's topic is about federal tax credits that impact families who have children. And although you can benefit from a couple of the credits I'm mentioning without involving children, predominantly they do involve children. And of course, we are talking about line 48 on the 1040. Just zoom in here for you. Credit for child and dependent care expenses. Line 51, the child tax credit. Line 64, the earned income credit. line 65, the additional child tax credit, and then over here, line 71B, which is the adoption credit. So that's what we're going to be talking about today. Now, last year I redid kind of the delivery of credits. In other years, I talked about credits in the order they appeared on the form without regard to whether they were family-oriented or not. And I decided after years of teaching and after years of supervising my preparers that the interrelationship of the credits that have to do with children are really fundamental to even getting it as a tax preparer. And I wanted to put them all into one session so we could see how the rules for each, while similar to the rules of the next, are different and unique to each credit individually, and to try and point out, these are the rules for this credit, these are the rules for this credit. Please don't confuse them. Sometimes they're the same, sometimes they're different. And hopefully by the end of the day, you'll start to get some semblance of maybe some of the similarities for the rules and some of the major differences. And as a starting point for that, I would like to have what I call a course discussion as we go through the day. And I'm going to be returning to it, but what I'd like you to do with the manual, if you have it printed, is be looking at this particular discussion point throughout today's class and maybe going back to it when something triggers in your mind that you have an answer and jotting that answer down. And as time goes on, when we get to the end of today's class, we will review an answer key for this particular topic, as well as answer keys for other assignments we have if we have enough time for all of them. It's another jam-packed session, and I usually don't have time for everything I want to fit in. But here is what we're going to be looking at. We have Jack and Sylvia, who are an unmarried couple that live together the entire year. They paid more than half the cost of supporting the following children who lived with them all year. We have George, who is age 9 and is the son of Jack, but not related to Sylvia. We have Samantha, who is age 9 and is the daughter of Jack and not related to Sylvia. We have Ben, age 14, who is not related to Jack, but is the son of Sylvia. We have Becky, who is the daughter of both Jack and Sylvia. And we have Jonathan, who is age 16, lived with Jack and Sylvia the entire year, but is not related to either of them. So let's just go through these again. George, age 9, and Samantha, age 12, are Jack's children. Sylvia is not their mother. Ben, age 14, is the son of Sylvia, but Jack is not his father. Becky, age 3, is the child of both Jack and Sylvia. And Jonathan, age 16, is the son of Sylvia's best friend who was incarcerated all year. Sylvia and Jack care for Jonathan as they would their own child and shared the cost of his support equally. Jack's earned income and his AGI is $23,000, and Jack paid 51% of the cost of keeping up the home. He received $200 of housing assistance each month last year. Jack paid $500 for after-school care for George during the year. Sylvia's earned income and AGI is $24,000. She paid 49% of the cost of keeping up the home. She received $400 in food stamps each month of the year. Sylvia paid $2,500 of child care expenses for Becky during the year. Please answer the following questions. What is Jack's filing status? What is Sylvia's filing status? Which children could Sylvia be able to claim as dependents on her return? Which children could Jack be able to claim as dependents on his return? Name the children Sylvia could claim for the child tax credit on her return. Name the children Jack could claim the child tax credit for on his return. Which children could Sylvia claim for earned income credit? And which children could Jack claim for earned income credit? Can Sylvia claim the child care credit? If yes, for which child or children? Can Jack claim the child care credit? If yes, for which child or children? What are the possible tax return and potential refund scenarios for Jack? Compute the refund scenarios for possible tax situations by completing the following chart. We look, of course, that we have Jack's AGI. What is his standard deduction going to be? Well, that's going to be dependent on his filing status, isn't it? So to know that, you have to figure that out. Exemption deductions, $3,700 for Jack plus each dependent claimed. So if he claims George and Samantha, what will that exemption deduction be? If he claims George, Samantha, and Becky, what will it be? If he claims George, Samantha, and Jonathan, what will it be? And if he claims George, Samantha, Becky, and Jonathan, what will it be? And we go through looking at these same 4 scenarios to compute his taxable income, his tax, his child care credit, his child tax credit, the tax after non-refundable credits, his earned income credit, and his additional child tax credit. And what would his refund due to credits be in each of those scenarios? And of course, we move over to Sylvia and do the same things for her with the different scenarios that are available to her. Now, in a way, I've answered some of those early questions for you already because I've not offered potentials that are not allowed. So, for example, you'll see that I've offered Ben, Becky, and Jonathan as examples for Sylvia that she could claim, but I've not offered George or Samantha because she would never be allowed those 2 dependents. All right, so I kind of give you a giveaway there. And then based on the calculations you completed for questions 11 and 12, what would be the best way for Sylvia and Jack to divide the dependency exemptions of all their children between them so that the best overall tax situation results for this family? So this is a family, isn't it? It's an unmarried family. It's a very common family. I see these come into my office hundreds of times over the years, just like this one. And that's why it occurred to me to turn it into a problem, because this is the type of problem that sends my tax preparers into spasms. So we're going to work our way through today, and as I'm going, and you think, aha, I know the answer to that part of the problem that April gave me just now, you can go fill that in. And at the end of the day, I'll show you the outcome or the answers. And session 13, password number 1 is Whidbey, W-H-I-D-B-E-Y. The first credit we're going to talk about today is the child and dependent care credit. Remember the first question, or one of the early questions in there, is how much child care credit can each of those filers, Jack and Sylvia, claim, and for which child or children can they claim it? Well, the rules for that are going to be discussed here. My first recommendation is not to confuse the child and dependent care credit with the child tax credit. And although they are entirely different credits, their names are similar enough that if you are taking a test and you're not paying attention to what you're doing, you may be answering a test question on the child tax credit and be thinking about the child and dependent care credit and give the wrong answer because you weren't paying attention. So I want to make sure whenever I'm teaching that my class always understands the specific terminology that I'm working on, and today it is a child and dependent care credit right here. So the child and dependent care credit relates specifically to the costs of paying for child care, and it is meant to help reduce taxes for families that pay child care or dependent care costs so that the parent or parents can go to work to earn a living. The credit also applies to taxpayers who are married to or have a dependent that is mentally or physically incapable of self-care. The entire onus behind this credit is that you are only allowed to claim it if you worked. If you are married, both you and your spouse must work. If you're not going to work, you can't have the credit. There is an exception for the spouse. If one spouse works and the other does not work, and the reason that the other one does not work is because they were unemployed and they were looking for a job, or they were a full-time student, or they were totally and permanently incapable of caring for themselves, then you can claim the credit even though your spouse had no earned income. But typically we're looking at earned income as a fundamental test. So you may only claim this credit if you work, you are looking for work, or if you are a student. If you are married, your spouse must also work or be a full-time student unless he or she is physically or mentally incapable of self-care. You may only claim the credit for a qualifying person who lived with you during the year. If you are separated from your spouse, you can only claim the credit if you were the custodial parent. So this is a question I get brought to me regularly. Me and my ex-husband split custody of our child Who gets to claim the child care? Well, the child care is going to go to the parent who has custody. And that custody is usually spelled out in the divorce decree. If the divorce decree is silent, custody goes to the parent who physically had the child the greatest amount of time during the year. And the IRS has boiled that down to, if there's an equal amount of time during the year, the IRS wants you to count the number of nights the child slept in a bed in your house, or on the couch in your house, but slept in your house. What the rule is that to claim the credit, if you are single, you must pay the child care so that you can go to work. If you are married and only one of you has a job and the other is a stay-at-home parent, then you're not paying child care because the parent needs to go to work. You're paying child care for possibly other reasons, but work would not be the motivation because the parent is there to take care of the kid. So and if you're unmarried, then you're only worried about whether or not you went to work. Now, in the case of Jack and Sylvia, Sylvia could be a stay-at-home mom, but because she's not married to Jack, that rule would not apply to Jack. So one of the things I like to say about the United States tax code is it discourages marriage in every possible way. So if you read the tax code and then make a marriage decision, the decision would probably be no. Now, there is an exception to that rule, and that exception is if you are marrying and one of you is not going to work. You're going to be the kept partner, husband or housewife, then marriage can be a good deal for the tax code. But with the modern family, the way it's constructed today, most women do work outside the home. Most men work outside the home simultaneously, and that scenario means marriage is typically not a good idea for taxes. At any rate, let's move on with the topic. So in order to claim the Child Independent Care Credit, you have to pass tests, and you have to pass all of the tests in order to claim the credit. The first test, test number 1, is called the Qualifying Person Test. You must file Form 2441 with Form 1040 or 1040A, and on the form you must identify the persons who qualify you for the credit. You must provide the name, Social Security, or ITIN of each qualifying person. To qualify you for the credit, the person must be one of the following: your dependent who was under age 13 when the care was provided and for whom you can claim a dependency exemption. So this is interesting. Most of the time when we talk about children, we're asking, was the child under a certain age on the last day of the year? But for the Child Independent Care Credit, it is merely, was the child under age 13 at the time the child received the care? So a child could turn 13 during the year, and you'd still get the credit for the earlier part of the year. There is an exception to this dependency exemption rule. If you are the custodial parent of your child for whom you cannot claim a dependency exemption because of a divorce or separation decree, or because you signed Form 8332 and released that child's exemption to the non-custodial parent, then you can still claim the Child Independent Care Credit even if you are not claiming that child as a dependent. You can also claim the credit for a person who is your spouse if your spouse was physically or mentally not able to care for herself or himself and who lived with you for more than half the year. Also, for your dependent who was physically or mentally incapable of self-care and for whom you can claim a dependency exemption or could have claimed the exemption except that individual had gross income that was too high. Keeping up a home test is test number 2. In order to claim this credit, you and your spouse, if married, must pay more than half the cost of keeping up a home for the year in which you live with the qualifying persons. So looking at Jack and Sylvia, has one of them flunked this test? Sylvia flunked it, yes. Jack earned less, but in the problem I told you he paid more than half the cost of keeping up the home. So he is the one that is going to pass this test. Sylvia flunks it. So it isn't based on your income, who had the most income. It's based on who paid more than half the cost of keeping up the home. Cost of keeping up a home includes rent, mortgage interest, property taxes, utilities, repairs, home insurance, and food eaten in the home, groceries. But the cost of keeping up a home does not include clothing, education, medical care, transportation, vacations, life insurance, the cost of purchasing your home, or replacing property, including your home. So you can see up here, groceries, rent, and the repairman are parts of costs of keeping up a home. But clothing for your dependents, the cost of educating your dependents, or even the cost of buying your home is not a cost of keeping up the home. The Earned Income Test. You and your spouse, unless either of you were physically or mentally incapable of self-care or either of you were students, must have earned income for the year. For purposes of this test, earned income includes, well, your job, wages, salaries, tips, and other employee compensation. Also, self-employment income. A net self-employment loss, however, will decrease your earned income. Non-taxable earned income, such as parsonage allowances, meals and lodging furnished for the convenience of the employer, voluntary salary deferrals, and military basic quarters and combat pay are also considered to be earned income. But earned income does not include any of these investment or retirement types of income, such as Social Security, pensions, annuities, investment income, scholarship income, unemployment, or workers' compensation. Special rule for student or disabled spouse. Your spouse is considered to have earned income for any months that he or she was a full-time student or was physically or mentally incapable of self-care. Your spouse must also live with you for more than half the year. Work-related expense test. You must pay the child and dependent care costs to enable you to work for pay or to look for work. If you did not work for the entire year, you must include only expenses you paid while you were working or looking for work. Payments to relatives. You must make payments for child or dependent care to someone you cannot claim as a dependent. If you paid your non-dependent child for the care, the child must be age 19 or older by the end of the year. So I paid my oldest child to babysit the younger kids will not fly unless the child is age 19 or older and you are not claiming that child as a dependent. Filing status, surprise, surprise, you cannot claim this credit if your status is married filing separately. And I would say this is just one of the #1 reasons I get a phone call from someone on my staff. My computer is not giving my client the child and dependent care credit. And the first thing I say is, what's the filing status? Because pretty much any computer software out there will not allow this credit when the filing status is married filing separate. The next one I get is, my computer is not allowing the child and dependent care credit. And my question is the status married filing separate? No, it's joint. Did the spouse work? Is the second question. Because again, the computer is looking for the earned income of the taxpayer and the earned income of the spouse. And if it's not seeing both of those fields filled in, again, it is not generating the credit. Test number 7 is the provider identification test. You must provide the person or business, or identify the person or business you pay to provide child care. You must provide the following information for each provider: the provider's name, address, and Social Security or EIN number. Due diligence is required in this regard. That is, the provider identification test is mandatory and you must fulfill it. However, if you cannot obtain the information because the provider refuses to give it to you or the provider is no longer available to give it to you, you can provide the information you do have and attach a statement. So if you try to obtain provider information and cannot because the provider refuses, you should report whatever information you have on page 1 of your Form 2441. Then enter See Attached Statement in the columns calling for the information that you do not have. Attach the statement explaining that you requested the information, but the provider did not give it to you. Write your name and Social Security number on the statement. The statement is considered to be due diligence. The next test is the Employer Paid Expenses Test. You must reduce your credit by any amount of dependent care expenses that your employer paid for you or which you had withheld from your pay tax-free. Dependent care benefits include amounts your employer pays for your qualifying person or the fair market value of free care you receive in a daycare facility provided by your employer. Your salary may have been reduced to show these benefits, and if you receive these benefits, these should be reported in box 10 of your Form W-2. Now those are the tests, but we also have some limits to discuss, and the first limit is the earned income credit. The amount of work-related expense you claim cannot be more than your earned income for the year if you are single or considered unmarried at the end of the year, or the smaller of you or your spouse's earned income for the year if you are married at the end of the year. But you can see here that if your spouse did not work because your spouse was either a student or not capable of self-care, then you will treat your spouse as if your spouse had earned income. So each month in which your spouse was a student or was incapable of self-care, is a month in which your spouse is treated as having earned income. Your spouse is considered to have earned income of $250 for each month for each qualifying person. So if you have one qualifying person, they would be treated as having $250 of earned income for the month. And if they had 2 or more qualifying persons, it would be $500 of income for the year. And what's 6 times 5? $33,000. And the credit per child is a maximum of $3,000. The maximum amount of dependent care expenses you can claim for the credit is $3,000 for one qualifying person and $6,000 for 2 or more qualifying persons. You must complete Form 2441 to calculate the credit, and the credit is a percentage of your allowable expense. The maximum amount of credit you are allowed to claim on the allowed expense is 35%. The minimum is 20%, and it's dependent upon your AGI. The minimum credit of only 20% is reached when your AGI hits $43,000 or more. Another reason why the marriage penalty works against you is doesn't matter what your filing status is, you hit this $43,000 and share it. So 43,000 just isn't that large a number, and it was 43,000 when I entered the industry 20 years ago. So let's take a look at the Form 2441, how it's laid out. In this yellow area for line 1, we enter the name, address, and Social Security or EIN number of the child care provider. In the column D, we enter the amount that we paid to each provider. If you have more than 2 providers to report, you would attach a statement. Next, in Part 2, we provide identifying information about the child or dependent for whom care was provided. First name, last name, identifying Social Security or ITIN, and then the amount of qualified expense paid for the care of that individual is entered in column C. On line 3, we enter the total amount spent on any care minus the amount shown on Form W-2 Box 10. So the maximum amount of qualifying expense is $3,000 for one qualifying person or $6,000 for 2 or more qualifying persons, but these totals must be reduced by any amount showing in Box 10 of your W-2. We then move down to the table that tells you what your decimal amount is. The decimal amount is based on your income, and you can see if your income is only $15,000, then the decimal amount is 35%. On the other hand, if you only earn $15,000 and you have a dependent, you're probably not going to pay tax anyway, so having a big decimal amount probably doesn't help you a whole lot down here. Most people, quite frankly, fall under this decimal amount right here, 20%. So most of the time when I'm figuring the child and dependent care credit, I'm going, oh, well, that's $600 for one kid and $1,200 for 2. That's kind of what I walk around with in my head, because 20% of $3,000 is $600 and 20% of $6,000 is $1,200, and quite frankly, most clients are either getting one or the other of those 2 numbers. Page 2 of the form is a little bit more confusing, but it's actually a section or a form that would have to be filled out on a regular basis, because if your client received child or dependent care benefits through their job and has a number in Box 10 of their W-2, then you have to fill out page 2 of this form. Page 1 looks pretty simple. Page 2 is a little more complicated. And you start off on page 2 by entering the amount of benefits shown in Box 10 of your W-2. Then on line 16, you enter the total qualified child care expenses you had here. And if the amount on line 12 is less than or equal to the amount on line 16, none of your benefits are taxable. You finish filling out Form 2441 and claim any amount of credit that is left that you're entitled to. In this section here on lines 19 and 18, it says, enter the amount of your earned income on line 18. And if you are married, enter your spouse's income on line 19. If your spouse had no earned income, you cannot claim a credit. Exception is if your spouse was a student or looking for work, and if so, see the instructions. And what the instructions will tell you is $250 per child per month that they were not capable of caring for themselves or they were a student, of course, of a maximum of $500 per month. So if your spouse was a student for a full-time student for 6 months, and you paid for child care for those 6 months to enable your spouse to be a student, and you had 2 children, then you would enter $3,000 on that line. 6 months times $500 per month is what you would enter there. Then on line 26, if your expenses were less than your benefits, enter the difference here. So in other words, if you have a number in Box 10 that is larger than the amount of expense you incurred for the year, and that does happen, the difference is taxable to you. Here's the other thing. Sometimes when I have clients call me, they've gotten a letter from the IRS because they use TurboTax to prepare their tax return. And when they were doing their tax return, they decided that they weren't going to mention anything about child care on their tax return because it was all paid through their job. And they think, well, I'm not allowed a credit anyway because it was paid through my job. But what happens is if you don't file 2441 with your return because your expenses were all paid for through your job, then the IRS treats you as having had no qualifying expenses and adds the dependent care benefit back into your income. So you get this letter, this nastygram saying, we've computed your tax and think you owe us money. When the reality is you need to file the form. So we're going to do an illustration, kind of a brief illustration here of what I mean. Illustration of a person who has taxable dependent care benefits. Holly Hobby was issued the following W-2 showing dependent care benefits of $5,000 in box 10. Her qualified expenses for the year, however, were only $4,800. So her benefits are more than her expense. Since her qualified expenses were less than her benefits, she's going to have to add $200 of forfeited dependent care benefits to her income. So you can see box 1 of her W-2 shows she earned $25,000 for the year. And if we assume that's the only income she had, then we would go over to the Form 1040 and we should see $25,000 on line 7. But we don't. We're going to have to enter that extra $200 of dependent care benefit and add that to her income. So instead of being $25,000, it's going to be $25,200. And you can see in the space provided, we've entered DCB and $200 in the space provided on the line. So moving on to the next topic, the child tax credit. Back in 1998, there was a lot of new benefits that came out. If you were in taxes back then, you'll remember that the child tax credit originally came out in 1998. And at that time, it was $400. And I can remember the news media, they call me usually when they want someone to talk on the news about taxes. I get called quite often. And that year at that time, I got a phone call from a news person. And I said, yeah, there's this fantastic new credit out, $400 per child tax credit. I think that's amazing. And they went, $400? That's nothing. But it was a lack of real comprehension. A $400 deduction doesn't amount to much, but a $400 credit is a lot. And of course, when we get to a $1,000 credit, it's a lot. And the child tax credit, if it is not renewed at the $1,000 rate, will expire at the end of 2012 and revert back to $400. So it used to be a much lower number, and it could be lower again. But for now, it is a full $1,000 for each qualifying child. You can claim the credit if you have a qualifying child on either Form 1040A, in which case it's on line 33, or on line 51 of Form 1040. Of course, in order to claim this credit, you have to have a qualifying child, and a qualifying child for purposes of the child tax credit would be different than a qualifying child for the child and dependent care credit, wouldn't it? So to be a qualifying child for this credit, you must be all of the following: your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, or a descendant of any of them, for example, your grandchild, niece, or nephew. Also under age 17 at the end of the year, did not provide more than 1/2 of his or her own support, lived with you for more than half of 2011, is claimed as a dependent on your tax return, and was a U.S. citizen, U.S. national, or a U.S. resident alien. How much is the credit? Well, it is the lesser of your federal tax liability after certain credits, or $1,000 for each qualifying child. If your credit is limited because your tax is less than your credit, you might possibly, if you're lucky, qualify for the additional child tax credit. And we'll talk about that in a bit. Income limits for the child tax credit. If your modified adjusted gross income is above the amount shown below for your filing status, your child tax credit will be reduced or eliminated. For married filing jointly, that limit is $110,000. For single or head of household, it's $75,000, and for married filing separately, it's $55,000. And I see large numbers of my clients phase out on these. So lots of clients don't get this credit because the phase outs, although they're respectable, they're not terribly high. you've got a working husband and a working wife, and they're both pulling in $50,000, $60,000 a year. I wouldn't call that extraordinary wages. They're comfortable middle-class wages, but they're already getting kicked out. Modified AGI. For purposes of the child tax credit, your modified AGI is your AGI plus the following amounts that may apply to you. Any amount you excluded from income because of the exclusion of income from Puerto Rico, or any amount you excluded under the foreign earned income exclusion, or any amount you excluded because you were a resident of American Samoa. If you do not have any of the above exclusions, your modified AGI and your AGI are the same number. If your AGI is above the amount shown for your filing status, complete the child tax credit worksheet shown below to compute your allowable credit. And what this worksheet does is it looks at the number of qualifying children you have, multiplies that by 1,000. It then goes down to your filing status and asks you to enter a number, in this case for married filing joint, say 110,000. And then as your income goes above 110, you start to lose that credit, and I think it phases out over a $10,000 or $15,000 range. By the time you're at 120, 25,000, it's gone. Refundable credits. So those are two non-refundable credits we've talked about. We're going to move on now to refundable credits. And there are important differences between refundable versus non-refundable credits. Non-refundable credits are taken as subtractions from your income tax, but refundable credits are treated as payments, like wage withholding. Now, refundable credits are essentially free money provided by the government. That's kind of the way I think of it. Therefore, there is an incentive to claim these credits improperly, either by ignorance or negligence. There's also an incentive to claim them through deliberate fraud. You should be careful to ensure that you thoroughly understand all the rules that apply to a refundable credit before you claim it on your return. Now, that can go a couple of ways. And much of where the tax industry is today, with the implementation of national registration for tax preparers, mandatory education, the elimination of the debt indicator, of course, telling lending banks and even taxpayers themselves whether or not they have a tax lien that's going to garnish their refund. That kind of information and changes in how it's being delivered really stem in many ways from the earned income credit and the amount of fraud that goes on around it. I can remember Senator John Glenn being in a tirade over fraud on the earned income credit back in 1995, actually 1994. It was something that you could read about in the newspaper, the criticisms he had of the administration of the program, and he was a Democratic senator, of course, back in the 90s and before that, because he made it to outer space, didn't he? Second man in space, something like that. So anyway, he really, I don't know if he disliked the earned income credit itself or more to the point the amount of fraud that it was causing. And over time, the IRS has implemented many, many different types of systems in an effort to cut down on the amount of fraud, but it's still rampant. Yeah, but tax preparers, as much as taxpayers, and perhaps even more so than taxpayers, are responsible for the fraud by encouraging it. And so that's a large reason why we're in where we are today with National Registration of Tax Preparers. That's my opinion. I'm very opinionated. Okay, so let's take a look at the rules for the earned income credit, because you're the tax preparer and you want to give this credit to your client. Well, you should want to give it. Now, I've had tax preparers working under my supervision who have personally disliked the credit. They've disliked it so much that they've refused to give it to their clients. I can remember my husband firing one of those preparers. It was like this ugly fight, and it was like the preparer got up and left, and my husband was there using a few language words I don't want to repeat on the air. And it all turned out that that preparer did not like the earned income credit and had not wanted to give it to a particular customer that he didn't feel should have it. But it's not our job as tax preparers to make those decisions, is it? We can like it, we can dislike it. It's really irrelevant. What's relevant is whether our client qualifies for it. And if our client qualifies for it, we give it to them. And if they don't qualify for it, we don't give it to them. There's my speech. We are the judge based on our comprehension of the law and the information we gain from our client during that interview. So let's take a look at it. The Earned Income Credit is refundable credit designed to help working low to moderate income individuals and families. Earned income defined. The term earned income means you must have worked during the year to be eligible to receive the credit. Earned income can come from wages, self-employment, or active participation in a partnership. Rules for taxpayers who do not have qualifying children. Now, I can remember a time where the only way you got the Earned Income Credit is if you had a qualifying child, but right around 1998 or a little bit before that, they came out with an Earned Income Credit for people who don't have children. It's probably around 96 or so in there. So you can get the Earned Income Credit if you don't have a qualifying child, but to do so, you have to meet these tests. First off, your total earned income as well as your adjusted gross income must be less than $13,660 or $5,000 roughly more than that number if you are filing a joint return. Your adjusted gross income is the amount shown on line 37 of your Form 1040, line 21 of 1048, or line 4 of your 1040-EZ. If you do not have a qualifying child, you must be at least age 25 but under 65. Now, I'm going to stop on this for a minute because we are looking at the rules for people without a qualifying child. And what I see tax preparers do is they get this 25 to 65 age stuck in their brain, and then they tell a person who has a qualifying child who is age 19 that they can't have the credit. So the only time the age of the filer is an issue is if the filer is claiming earned income credit and they don't have a qualifying child. If they do have a qualifying child, we don't care about their age. We care about the age of the child, but we don't care about the age of the taxpayer or the taxpayer's spouse. So you must be at least age 25 but under age 65 if you do not have a qualifying child. You cannot be the dependent or qualifying child of another person. You must have lived in the United States for more than half the year. You and your spouse, if filing joint, must have a valid Social Security number. Your filing status cannot be married filing separately. You must have been a U.S. citizen or resident alien for the entire year. You cannot file Form 2555 or Form 2555-EZ to exclude your foreign earned income from your U.S. tax return as taxable. And your investment income must be $3,150 or less, and of course you must have earned income. So those are the rules for people who don't have qualifying children. Now let's look at the rules for people who do have qualifying children, because our job as tax preparers is to have each of these separate sets of rules cemented in our minds. So if you have a qualifying child, one or more, you must meet these rules. The first one is that your total earned income as well as your adjusted gross income must be less than the amount shown on these three lines based on your filing status and the number of children that you have. If you have one child as a qualifying child, then your income must be less than $36,052, but you add roughly $5,000 to that number if you're filing a joint return. If you have two or more qualifying children, your income can be as high as $40,964, add $5,000 for joint. And if you have three or more qualifying children, your income must be less than $43,998 or $49,000 if married filing joint. Now this three or more qualifying children, this also is a temporary rule. It expires at the end of 2012 where we revert to a maximum credit based on 2 children. So this is, for those of you who've been in it for a while, are well aware that this is unique. And if you're new to the industry, you may not realize that there usually was only a credit based on 2 children and that we are in a temporary window of time where we have up to 3. Also, your child must meet the relationship, age, residency, and joint return tests. Your qualifying child cannot be used by more than one person to claim the earned income credit. You cannot be the qualifying child of another person. You, your spouse, if filing joint, and your qualifying child must all have valid Social Security numbers. Your filing status cannot be married filing separately. You must have been a U.S. citizen or resident alien all year. You cannot file Form 2555. Your investment income must be $3,150 or less, and you must have earned income. So you can see some similarities between some of these rules and some differences. Yes? Investment income is passive Oh, yes. There's a comment in the classroom. Does investment income include passive income? And the answer is yes, it does. So example, rental. Relationship test. Your child must be son, daughter, stepchild, adopted child, eligible foster child, or a descendant of any of them, for example, a grandchild, or a niece or nephew. And that falls under here. Brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of them, niece or nephew. And there's a little notation here. It says an eligible foster child must be placed with you by an authorized agency. So you can't just identify a person and say, oh, this is my foster child, and claim that person. Now, another one that I get a lot of is I'll have a client coming in and sitting across from me who says, yeah, I'm claiming my stepson this year. And I go, where's his father? Oh, well, he lives with us. Well, how come you're not filing a joint return with the father? Well, we ain't married. Okay, then this child is not your stepchild. Because in order to be the stepchild, you would have had to have married his father, in which case you'd be here with that father filing a joint return. So anytime I'm given this stepchild option here, my alarm bells just go, woo, full force. Age test. Your child must be under age 19 at the end of the year and younger than you or your spouse if filing jointly. Under age 24 at the end of the year and a student and younger than you or your spouse if filing jointly, or permanently and totally disabled at any time during the year regardless of age. So I've kind of got this less than 19, a student less than 24 and younger than you, or none of this matters because they're disabled. Those are the scenarios. Student defined. To qualify as a student, your child must be, during some part of each of any of 5 calendar months during the year, a full-time student at a school that has a regular teaching staff, course of study, and a regular student body, or a student taking full-time on-farm training course given by a school described in 1 above, right here, or a state, county, or local government. The 5 calendar months do not need to be consecutive. And as far as the IRS is concerned, a full-time student is a student who is enrolled for the number of hours or courses that the school considers to be full-time attendance. So IRS says the definition of full-time is whatever that school says is full-time. So you have a kid that went to school January, February, March, April, May. 5 months, right? How many kids graduate from school after going for 5 months? Well, if you're in 12th grade, you typically finish up in the first week of June, right? So you would have been full-time for at least the first 5 months. And I think that's what they're getting at. So you could have a kid that during the year is 18 years old, finishes high school, June, finishes high school. They went to school in the first 5 months, and they were full-time in the time that they were there. And then fall comes. Did they go to college? It doesn't matter. As long as they're still under age 19, they can be out of school, they can be graduated, they can be loafing on the couch. What do we call that? Couch potato? Whatever happens to the kids when they finish high school and don't go on to college and they're sitting on the couch because they don't have a job. Anyway, they can be that. That's fine. In fact, they can be more than that. They could finish school and go on and get a job. They could earn $10,000 after they finish school, and they could still qualify you for earned income credits. There's a question, do you have to claim their dependency exemption? Well, we'll see that one of the rules for EIC does not entail the dependency exemption. You do not need to claim your child as a dependent to claim earned income credit for them. That is not one of the rules. So another illustration, in that illustration I had a child who was under age 19, but what if my child turned 19 during the year and they finished high school in June? Would anything in that story I just gave you change? Could still claim him for earned income credit because even though he was not under age 19, he was still a full-time student for at least some part each of 5 calendar months and was under age 24. Now, if we get to the point where we've got the junior who's finished college, and junior finished college at the age of 24 and went to college through May, well, you're out of luck because age 24 is not under age 24. And even though they were full-time students for the first part of the year, we're also looking at that magic age of being under age 24. The next test we look at is the joint return test. And to meet this test, the child cannot file a joint tax return for the year. There is, however, an exception to the joint return test if your child and his or her spouse file a joint return only as a claim for refund, and neither of them would have any tax liability on their separate returns. Residency test. Your child must have lived with you in the United States for more than 6 months during 2011. So this is one of the tests that some people have a hard time grasping. The part with my child had to live with me more than half the year. I cannot claim a credit on a child who didn't live with me, but we'll see what the IRS determines living with me means. So there's the factual part where they sleep under my roof every night, and there's the part where they could be under my roof but they're not. What happens then? Also, inside the United States means the 50 states and the District of Columbia, but it does not include U.S. possessions such as Guam or Puerto Rico. Homeless shelter. Your home can be any location where you regularly live. You do not need to have a traditional home. For example, if your child lived with you for more than half the year in one or more homeless shelters, your child meets the residency test. Also, military personnel stationed outside of the United States on extended active duty are considered to live inside the United States during that duty period for purposes of earned income credits. Birth or death of a child who is born or died during the year is treated as having lived with you for all of the year if your home was that child's home for the entire time that he or she was alive. Now here's the one that is important, and this is the temporary absence one, and it throws tax clients off and it also throws tax preparers off. Count time that your child is away from home on a temporary absence due to special circumstance as time that the child actually lived with you. Examples of special circumstance include illness, school attendance, business, vacation, military service, and detention at a juvenile facility. So this is the most common one I run across, not juvenile facilities, but college. My client says, well, I can't claim my kid this year. They're gone to college. They've got their own place now. I can't claim them. Okay, so where are they living? Well, we rented a house for them. So who's paying the rent? Oh, I am. And now what happens when summer comes? Does he stay there and get a job and pay his own way, or does he come home for summer? Oh, he comes home for summer. And does he have another home that he calls his own besides your home? No. Well, that's an example of temporary absence. My child has gone away for the school year, and when my child finishes the time away, they will be coming home. Their absence is temporary, and that's what the IRS is looking at. Yes? What if they don't come home for summer? Well, then I would be looking at why are they not coming home for summer? Are they working? Are they paying their own rent? Are they pretty much gone from home and independent? Or are they taking summer classes? They wanted to do a bit of vacationing and traveling during the summer break instead of hanging around mom's boring house. So I would be looking at the reason for the absence. Is the reason for the absence just because they're still at school, taking a vacation, or is it because they really are setting up a new life for themselves in a new location and making that their home? Kidnapped child. A kidnapped child is treated as living with you for more than half of the year if the child lived with you for more than half of the part of the year before the date of the kidnapping. The child must be presumed by law enforcement authorities to have been kidnapped by someone who is not a member of your family or the child's family. This treatment applies to all years until the child is returned. However, the last year that the treatment can apply is the earlier of the year that there is a determination that the child is dead or the year that the child would have reached the age of 18. If your qualifying child has been kidnapped and meets these requirements, enter KC instead of a number on line 6 of Schedule EIC. Valid Social Security card. Unless your child was born and died during the year, you and your spouse, if filing a joint return, and your child must all have valid Social Security numbers. You cannot claim earned income credit if you or your spouse, if filing joint, or your qualifying child's Social Security number is missing or incorrect on your tax return. Now, with the era of electronic filing, and for as long as I've been in taxes, I've been e-filing, I'm not new to it, My very first year, even when I didn't know what the 1040 form was, I knew how to push e-file and make that happen. I got my EFIN back in 1992 before I knew what the 1040 form was. So totally different requirements. But back then, 20 years ago, as today, the IRS matches fields on the return. It looks at the last 4 characters, or the first 4 characters of the last name of the child, and matches those with the Social Security number of the child and the year of birth for the child. It will match all 3 of those fields, and if there is a mismatch, the tax return is rejected. Now, if the tax return is rejected for a mismatch, the IRS will give a reject code explaining the reason that it was rejected. It'll say that there is a mismatch between the name and the Social Security number, and or a mismatch between the name, Social Security number, and the year of birth. In which case, you go back to the client and say, okay, we've got this information wrong. Now, some clients come in and they're very well behaved and they follow instructions and they bring the Social Security numbers of their children, or the Social Security cards. We actually get that card, and I love cards, and I always make a copy of it, because if I make a typo, I can go back to the card and see what the number really is before I call the client and let them know I goofed up. But if they don't have a card, and often they don't, and they've just got their child's Social Security number written on a piece of paper somewhere, I don't like that, because they may have the number right, but have they given me the right name for the child? Now, when you're dealing with Mr. and Mrs. Smith who've been married, and Mrs. Smith took Mr. Smith's name, and all of the children are named Smith, it's probably a sure bet what that child's last name is. But when Betty had a child with George, and Betty has never been married to George, and Betty decided to give the child both their last names, now my question is it a hyphenated last name? Is her name the middle name, or is it the last name? It can be multiple tries to get a tax return like that through. Husband, wife get married. Wife takes husband's name but never goes to Social Security to change her name. Now, of course, that will cause a reject on the spouse field of the tax return or the taxpayer field. But you know, our computer software, when I type in the first name of a dependent, it assumes that dependent's name is the same as the taxpayer name unless I type otherwise. So if you're kind of doing quick entry, your computer software can assume something that's not accurate as well.
Session 13 password number 2 is Island, I-S-L-A-N-D.
This Social Security card, it is really easy to see what is the first name and what is the last name because, well, there's only 2 options. John is first, Doe is second. But sometimes what we'll see is John Doe Smith. And if there's no hyphen between Doe and Smith, then the last name is Smith. But if Doe is hyphenated to Smith, then the last name is Doe hyphen. Because we're going to be looking at the first 4 letters of the last name, that would be D-O-E hyphen. And the IRS doesn't actually take hyphens, so it would probably take an empty field, an empty space. Because when you're dealing with electronic filing, in the old legacy system of electronic filing, the IRS would not accept characters of any kind except true numbers and true letters. So you couldn't enter a hyphen, you couldn't enter an apostrophe. I've seen some names where, you know, Desjardins is the name and they've got this apostrophe after the D, and it'll show up on the Social Security card, but IRS won't register that field. Now, under the new modernized e-file, it may be that they're more adaptive to that, but I'm not seeing it yet. Now, the other way I've seen Social Security cards is we've got John Doe, George Smith. Then in a situation where you've got names on the top line and names on the bottom line, the first 4 letters of the first name on the bottom line is the name I'd go with as the last name on the card. Okay. So you cannot claim earned income credit if you can't get the name of the child matching the Social Security number. That's the bottom line of this speech. You and your spouse, if married filing jointly, or your qualifying Social Security card says not valid for employment. If the card says that, and the only reason you were issued the card was to get a federally funded benefit, you cannot have earned income credit. You or your spouse, if filing jointly, or your child has an ITIN, Individual Taxpayer Identification Number, or ATIN, Adoption Taxpayer Identification Number, you are not eligible for earned income credit. Your qualifying child cannot be used by more than one person to claim the earned income credit. If 2 or more people qualify to claim the same child, only one may claim that child. Who will claim the child in that situation? Well, you can agree between yourselves who will claim the child. So let's go back to our classroom discussion. We've got Jack and Sylvia, and they've got this house full of kids. Are they allowed to decide between them who will claim each child? The answer is for some of the children they can do this, and for some of the children they are not allowed to do it. So you can agree between yourselves who will claim the child for earned income credit. However, if a parent can claim the child as a qualifying child, but no parent claims the child, then the child is treated as the qualifying child of the person who had the highest adjusted gross income for the year, but only if that person's AGI is higher than the highest AGI of any of the child's parents who can claim the credit. So what this is saying, and you kind of have to imagine a household where this could be the case. We have a household with mom and grandma and grandchild. And mother is the mother of the grandchild, right? And grandma is the grandmother of the, well, grandchild. And mother of the mother, right? You can see this triangle. Okay. Does that ever happen? Of course it does. So you've got, let's give our characters names. You've got Alice is the mom, Betty is the grandma, and Jackie. Jackie is the grandchild. Okay. In this scenario, the mother will always win. She'll always be the one who can claim Jackie. And Betty, the grandma up at the top, is also potentially eligible to claim Jackie because grandma with Jackie can also have a qualifying child relationship. They're both related in a close enough way that grandma could call Jackie the qualifying child. But because the mother is in the equation, the child will always default to the parent first. But the mother of Jackie could say to her mother, Betty, I'm going to allow you to claim Jackie for earned income credits. That is allowed as long as the mother or the grandmother, Betty, in every way passes all of the tests in her own right, so that they're living together with the child for more than half the year and meet the relationship, age, and residency tests, right? So if grandma meets those tests, then it's possible for the daughter to give the child to grandma, but only if grandma earns more. If grandma doesn't earn as much, then it's not allowed. So if the child's parents file a joint return with each other, this rule can be applied by treating the parent's total AGI as divided equally between them. You can decide who will claim the child, or if you both cannot agree who will claim the child, the tiebreaker rules shall determine who can claim the child. And it seems to me this is a good point to take a break. We're at the top of the hour. And so maybe during this 10-minute break, you could do a couple of things for me. One is read through Jack and Sylvia classroom discussion a little bit and jot down some answers. And the other one is there's a classwork assignment at the end of the manual, classwork number 1. And it has a series of questions relating to the child and dependent care credit. And we have finished that topic. So when we come back from our break, we will pick up on the tiebreaker rules, but we'll also review the answer key to that classwork number 1 that has to do with the child and dependent care credit. And you can see it starts on page 37 of the manual. And the first question is, Janice's husband, Harry, was disabled and unable to care for himself the entire year. Janice hired an attendant to care for her husband in their home while she was at work. Janice and Harry will file a joint return. They are eligible to claim the child and dependent care credit, true or false. So just while we're on our 10-minute break, you can work on Jack and Sylvia problem. You can work on this problem. When we come back after the break, we'll review the classwork assignment. Okay, webinar students, I am going to be reading through this first classwork assignment with you, and all of you in the classroom and online can participate by saying yay or nay to each of these filers in classwork assignment 1 as to whether or not they can claim the child and dependent care credits. So at the start of the break, I read this assignment to you, but let's take it again. Janice's husband, Harry, was disabled and unable to care for himself for the entire year, so she hired an attendant to care for her husband in their home while she was at work. Janice and Harry will file a joint return. They are eligible to claim the child and dependent care credit, true or false. So if you're online, you can give me a red X if you think it's a no, and you can give me a green check mark if you think it's a yes. What is the feedback in the classroom? Yes or no? Yeah, this one's a yes, absolutely. Now, not only is it a yes for the child and dependent care credit, in this case it would be the dependent care part of dependent care credit, this particular expense would also qualify as a medical expense. So if you're paying a care provider to care for your spouse so that you can go to work, or even if you're not going to work, you just need a care provider to care for your spouse because they need that medical attention, that care providing does qualify as a medical expense on Schedule A. But of course, you cannot claim a medical expense on Schedule A and a dependent care credit for the same expense. Can you do the difference? Yes, you would be able to do the difference. So if you wanted to, you could claim a credit on part and a deduction on the other. Now, depending on your income level, you might find that, once you beat the 7.5% limit on medical, depending on your tax bracket, you may just overall benefit far more by claiming the medical deduction. But you may find that the medical deduction never approaches the number it needs to be, and so you're better off with what credit you can get. Question number 2, Laura is single. She paid her 18-year-old son, Sam, to care for her younger children while she was at work. Laura will not be able to claim Sam as her dependent. Laura can claim the child and dependent care credit. True or false? That one is a false. And the reason it's false is even though her child is not her dependent, he is not age 19 or older. He is age 18. So he is too young. Next one, Jill is married to Jack. Jack left Jill and moved out of the home in May, on the 1st of May. Jill worked and supported their 2 children, ages 8 and 10, for the remainder of the year. Jill worked all year and paid more than half the cost of maintaining her household. She paid for before and after school care for her children while she was at work. She will not be filing a joint return with Jack. Jill can claim the child and dependent care credit. True or false? That's interesting. Number 2 confused more people than number 3, but we do have some split votes online there. Okay, here's the deal. We have to look to see what filing status Jill is going to file with. The filing status choices she has are married filing separate and head of household. Does she meet the tests for head of household? Well, she would need to meet the test for being considered unmarried. And to be considered unmarried, she has to maintain a household for a child, a qualifying child, whom she can claim as a dependent, or could have claimed as a dependent, except she signed that exemption away to the non-custodial parent. She must have paid more than half the cost of keeping up her household for the year in which her child lived, and her husband cannot have lived with her at any time in the last 6 months of the year. Did the husband live with her at any time in the last 6 months of the year? No, he moved out in the first half of the year, so he was not there in the second half of the year. Therefore, the answer is yes, she can claim the child and dependent care credit. 4, Betty and John are married. Betty worked all year. John was employed and looking for work for 2 months and was a full-time student for 7 months. Their 2-year-old daughter was enrolled at preschool whenever John was at school or looking for work. Betty and John will be able to claim the child and dependent care credit for their joint return. True or false? That is a true. How much is the credit going to be based upon? What is the qualifying expense? There's 2 numbers we're concerned about. Yeah, so we're looking at a number of limits. The first one is how much money did she make working? The second one is the limit per child, which is $3,000, and the third one is the limit based on the number of months he was either a student or looking for work. And he's allowed $250 for each child for each month that he was looking for work or going to school. So that's 9 months times $250, or a maximum qualifying expense of $2,250 for that year. And what would the credit be? I haven't given you enough information. You have no clue what the credit would be. You don't know what her decimal factor is because I haven't told you what her income is. Okay, question number 5. Sally and Joe are married and both work full-time. Sally's mother, Winifred, lives with them and cares for their 5-year-old son. They pay Winifred to care for their son, and Winifred is not their dependent. Sally and Joe can claim the child and dependent care credit. True or false? And the answer is true. Winifred is related, but Winifred is not their dependent and is not under age 19. And question number 6, the last in line. Jackie is separated from her spouse, Tim. They did not live together at any time during the year. Tim pays child support to Jackie, and she has signed Form 8332 granting Tim the dependency exemption for their child. Jackie worked all year and paid child care expenses for her 3-year-old child. Jackie can claim the child independent care credit. True or false? False? True. True. I had someone in the classroom go no, and then I don't know. I have no clue. All right, the answer is true. Jackie would be entitled to claim the child as a dependent, except she signed Form 8332, and the fact that she signed 8332 means she's lost the dependency exemption, but she's still going to be allowed to claim the child independent care credit. So where does it say that in our manual? Well, we would have to go all the way back up to test number 1. So let's go in our manual back to page 7 and just revisit that test. The page here. Oops. I typed 7 and nothing happened. There we are. Test number 1. To qualify you for the credit, the person must be one of the following: your dependent who was under age 13 when the care was provided and for whom you can claim a dependency exemption. Exception: you are the custodial parent of your child for whom you cannot claim a dependency exemption because of a divorce separation decree or because you signed Form 8332. So there it was, the very first test we covered. So in our manual now, we are going to move on to where we left off, which was on page 20. And we were going to move on to a discussion of the tiebreaker rules. And the tiebreaker rules come into play when we have 2 or more people who qualify to claim a child for the Earned Income Credit. So the Earned Income Credit is a credit that you have to meet all of the tests for. There are 4 tests, and it is entirely feasible that in a single house, more than 2 people or more than 1 person could pass every test. And when that happens, the tiebreaker rules kick in. Now, it is the case that you can, between yourselves, decide who will claim that child for tax benefits. So the tiebreaker rules really kick in when you can't agree. If there's a feud going on and you're both fighting over, or 3 people are fighting over the same child, do you think that ever happens? Fighting over a child? Yes, it happens all the time. And so the tiebreaker rules are meant to help settle who is entitled to that child. So the tiebreaker rules apply if you cannot agree who will claim the child. And under the tiebreaker rules, the child can be treated as the qualifying child only by the parent if only one of the persons is the child's parent. The parent with whom the child lived the longest period of time during the year if 2 of the persons are the parents of the child. So the first rule is the parent always wins no matter what. It doesn't matter how much support the grandparent provided. It doesn't matter how much support the aunt provided. It doesn't matter how much support the sister provided. If the parent was in the house and meets all of the tests, the parent always wins. The next rule is that if both of the people fighting over the kid are both the parents, now we're going to look at who lived with the child the longest. Whoever had the child the most number of days during the year is the winner. But if both parents lived with that child the exact same amount of time for the year, then the parent who earns the most, who has the highest adjusted gross income, wins. If neither of the persons who qualify and are fighting over this child for the Earned Income Credit are the parents, then the winner is the person who had the highest AGI. We have a child who can qualify a taxpayer for a number of benefits. The Earned Income Credit is only one of them. The child can also qualify you for a dependency exemption deduction, possibly a child tax credit, the head of household filing status, the credit for child and dependent care expenses, and exclusion of dependent care benefits from W-2 income. So when you are settling who will claim a particular child for the Earned Income Credit, you are also settling how the child's other tax benefits will be applied. There was a brief period of time where the IRS allowed some of the benefit associated with the child to go to one filer and the remaining part of the benefit to go to another filer. If you were around, you could remember that. It was really between about 1998 and 2004 that you literally could have one person claim a child for dependency and head of household and another person in the same house claim that child for the Earned Income Credit. But as of 2005 and later years, that is no longer allowed. If you've got 2 people living together with a qualifying child, they can agree between them who will be able to claim that child if they both meet the tests for claiming that child. But all of the benefits associated with that child will travel to the parent or the person ultimately claiming that child. You can't split the benefits. And the only exception to that is if the non-custodial parent is entitled to claim the child's dependency exemption, the child may be claimed for the child tax credit and dependency on the non-custodial parent's return and will be eligible for all other benefits on the return of the custodial parent. So let's look at the other benefits. If we have a non-custodial parent who has received a Form 8332 entitling him to claim the dependency exemption and the child tax credit for his child that he is not custodial over, then the other benefits left that could be claimed by the custodial parent include head of household, child and dependent care credit, and the exclusion for dependent care benefits on a Form W-2 and the earned income credit. But this earned income credit figure, the head of household, and the credit for child and dependent care expenses can never go to a non-custodial parent because the tests for child and dependent care credit are the child has to live with you more than half the year. The tests for head of household are the child has to live with you for more than half the year, and the tests for the earned income credit are the child has to live with you more than half the year. So the non-custodial parent can never win those tests. Unless, of course, you're non-custodial in a divorce decree, but the child lived with you anyway. I've seen that. Then what do you do? All right. EIC rules summarized. Okay. If your mind's swimming, let's throw it at you one more time. To qualify for the credit, you must meet the following rules. You must have a valid Social Security number. If your Social Security card says not valid for employment and you were issued the card so you could get a federally funded benefit such as Medicare, you do not qualify for EIC. Your filing status cannot be married filing separately. You must be a U.S. citizen or resident alien all year. You must have lived in the United States for more than half of the year if you do not have a qualifying child. If you have a qualifying child, the child must have lived with you in the United States for more than half the year. You cannot file Form 2555 to exclude income. Your investment income must be $31.50 or less, and you must have earned income. Now, this is a table out of IRS Pub 17, Table 35.1. You can find the same exact table in the IRS publication exclusively devoted to the earned income credit. There is a publication that does nothing but talk about the earned income credit. And actually, there's a page on the IRS site. I think we have time in class today. I'm going to show it to you because it's a really good site. Worth seeing, worth checking out. But let's look at the table first. Earned income credit in a nutshell. We have Part A, which is rules that apply to everyone. We have Part B, which is rules that apply only if you have a qualifying child. We have Part C, which is for rules if you do not have a qualifying child. And then we have Part D, which is rules that apply to everyone in terms of calculating the credit. So, of course, Part A, Column 1, and Part D appear to be saying the same thing. But Part A is talking about how much adjusted gross income you have and that it must be less than the amount shown here. And over in Column D, it's saying your earned income must be less than the amount shown here. So not only must your earned income be less than what you see here, your total adjusted gross income must also be less. So that's the difference between those two columns. It's just that first sentence, AGI as opposed to earned income. Then we go on to Part A, rules for everyone. You must have a valid Social Security card. Your filing status cannot be married filing separately. You must be a U.S. citizen or a resident alien the entire year. You cannot file Form 2555. Your investment income must be $31.50 or less, and you must have earned income. Then we go over to Part B, and you can see there's only 3 extra rules that apply if you have a qualifying child. Those rules are that the child must meet the relationship, age, residency, and joint return tests. Your qualifying child cannot be used by more than one person to claim EIC, and you cannot be the qualifying child of another person. Under Part C, we have 4 additional rules that apply if you do not have a qualifying child. Rule number 1, you must be at least age 25, but not 65 or older. You cannot be the dependent of another person. You cannot be the qualifying child of another person. You must live in the United States for more than half the year. All right, how do we go about claiming EIC? Well, how you go about claiming the EIC depends on whether or not you have a qualifying child. If you do not have a qualifying child, it's pretty simple. You go to the Earned Income Credit tables, you look up the EIC based on your earned income and your adjusted gross income, and you enter the number on the form. It goes on line 64A of 1040, line 38A of 1040A, and you can even claim it on the 1040EZ form on line 8A. But if you do have a qualifying child, you figure your earned income credit using the EIC worksheets and tables. You then complete Schedule EIC and attach it to your return and enter the credit amount on line 38A. And of course, the Schedule EIC must be attached for a qualifying child. If you leave it off, then you don't get the credit. And here is the EIC schedule. Let's take a zoom in on it a little and see what it's asking for here. I can fit it all in. Make this about 180. Okay. So you can see that the form is actually pretty simple. In the world of forms, this is one of the easier ones. It's asking for the child's name. It wants to know the first child's name, the second child's name, and the third child's name. Now, in the olden days, when I first got into this business, there was a rule about whose child, or the order that the children went in. And the order was that the youngest child was listed first, the second youngest child was listed second, and the third youngest child was listed fourth, or third. And if you had older children, they weren't listed on the form at all, even if they would qualify for the credit. Well, I can't find that instruction anywhere in the Earned Income Credit instructions anymore. There's nowhere I can find in modern times where it tells you that that's the rule. It used to be a rule a while back. When they took it out, I don't know. But interestingly, our software company still follows that rule. And it can cause headaches when you're preparing a tax return because you need to fill out earned income credit and answer a checklist for each child. There is this earned income credit due diligence checklist, and it wants you to go through and answer all the questions about the child. And if you entered the children on the dependency screen in a different order than their age, then the software will typically rearrange the children and put them in the order of the age on the EIC schedule. So you could have on the front of the tax return in the dependency field the oldest child listed first, but your software is going to flip it and put the oldest child last. So you need to recognize that when you're answering the due diligence checklist questions in your software, and that your software may be disallowing the credit for one of the dependent children, and the reason it's doing it is you've not filled out the checklist for the child that the software wants you to fill it out for. And you're not figuring that out because you're going, but I've filled it out for that kid. And you're not realizing that the software has put that child in a different order than you're answering the questions. So for example, on the Drake software that we're using, we have one screen where we enter the name, social security, date of birth of the child, and we also answer a couple of questions about the child. Is the child your qualifying child, and so forth. Then we go over to another screen completely where we answer more due diligence questions. And one of those questions is, if you were asked to prove that this child lived with you, what evidence do you have? And on that screen, the child is ordered, or the children questions are ordered in the order they will appear on the form. So if you go in there and say, okay, the second child I entered under dependency was George, so I'll go to the second column on this screen. That could be the wrong column because George is the youngest child, so you need to go to the first column, even though George is the second child in order. So this is just a tip if you are having problems in your software getting this EIC form to generate. I would be looking to see how the software is thinking and make sure you're falling in line with it. So the first thing is, of course, enter for each child, knowing your software will probably put the children in the order of their age. Enter the social security number of your child. If your child died during the year before they had a chance to get a social security number, you would write the word died, and you can see here. If your child was born and died in 2011 and did not have a social security number, enter died on this line and attach a copy of the birth certificate, death certificate, or hospital medical records. Year of birth, you would enter the year of birth on here. The IRS does not match the date of birth, they match the year of birth. Line 4, it says, was the child under age 24 at the end of the year, a student and younger than you, or your spouse if filing jointly? You would answer yes or no. Was the child permanently and totally disabled during any part of 2011? Yes or no. child's relationship to you. You want to enter son, daughter, grandchild, niece, nephew, foster child, etc. And then the number of months that the child lived with you in the United States. And it says, if the child lived with you for more than half of 2011, but lived with you for less than 7 months, put 7 months here. So if we've got a split custody arrangement where a child is living half the year with the mom and half the year with the dad, but the mom can show that she's custodial and the child was essentially with her maybe 6 months and 3 days, she's going to put 7 months here. That's what the instructions say. If the child was born or died in 2011 and your home was the child's home for the entire time that he or she was alive, enter 12. Now, if you have a client who says, yeah, my child was born and only lived for 3 days, so you enter 0 here, what do you think the software is going to do? Not allow the credit, because the instructions say to, well, enter 12. Form 8862, reclaim of the earned income credit after denial. Now, how often do we see this form come up? I see it all the time. If you qualify to claim the earned income credit by meeting all of the tests that we've just described and the tests that are listed in Pub 17 or Publication 596, which is the EIC publication, for any year after 1996, and in a year prior your earned income credit was denied, then you have to attach Form 8862 to reapply for the credit. And what does this form do? It essentially asks you all of the questions needed to establish whether or not you are entitled to claim the earned income credit for this child. But the IRS says do not file this form if either 1 or 2 below is true. Number 1, after your earned income credit was reduced or disallowed in an earlier year, you then filed Form 8862 in a later year and your EIC for that later year was allowed. So what this is saying is if you've been denied in the past, and you are now applying for the earned income credit again, you have to attach the form. But do not attach the form if, after being denied in the past, you attached the form and the credit was given to you. They only want it once. But if you were denied a second time, then you have to attach it again. Or number 2, your EIC has not been reduced or disallowed again for any reason other than a math or clerical error, and it's actually an and. So you filed 8862 in a later year and it was granted to you, and since then it has not been reduced or disallowed for any reason other than a math or clerical error. Number 2, you are taking the EIC without a qualifying child for 2011. And the only reason your EIC was reduced or disallowed in an earlier year was because the IRS determined that a child listed on the schedule EIC was not your qualifying child. So if in an earlier year you claimed earned income credit for a child that was not your child, not your qualifying child, for purposes of calculating the credit, that's the exact reason you typically need to attach the form. But in a later year, maybe you're just falling in a low enough income bracket that you qualify for earned income credit without having a qualifying child, then you don't need to attach the form because the form is only associated typically with making a claim if you have a qualifying child. Also, do not file Form 8862 or take the earned income credit for 2 years after there was a final determination that your EIC claim was due to reckless or intentional disregard of the EIC rules, or for 10 years after there was a final determination that your EIC claim was due to fraud. Exception for math or clerical errors. If your EIC was denied or reduced as a result of a math or clerical error, do not attach Form 8862 to your next tax return. For example, if your arithmetic is incorrect, the IRS can correct it. If you do not provide a correct Social Security number, the IRS can deny the earned income credit. These kinds of errors are called math or clerical errors. Omission of Form 8862. If you are required to attach the form and then you claim EIC without attaching the form, guess what? Your claim will automatically be denied. Now, fortunately, with the era of electronic filing, if the form is required and it's not attached, you will receive a reject code from the IRS, and the reject code will say, attach the form. So, well, you're going to have to get the information from your client necessary to complete the form, attach the form, the completed form, and then retransmit. Additional documents may be required. This is no surprise. You may have to provide the IRS with additional documents or information before a refund relating to EIC is released to you, even if you attach a properly completed 8862. I would say probably almost 100% likelihood they're going to ask for proof. 8862 is also going to cause a big delay in the refund. If you are attaching this form to your client's tax return, I think it's safe to say that the delay will be a minimum of 6 months while they sort it out. I don't think it's going to be any time in a few weeks. It's going to be a while, particularly if the IRS is asking to verify information. Here's the system the IRS has for verifying information. First off, the tax return gets processed, and then there's a due date that you would expect the refund that passes. And then there's a few more weeks after that where the client gets their letter saying, we need you to provide that documentation. Then there's the period of time it takes to put that documentation together and send it to the IRS. And then there's the period of time where it's circulating through the systems at IRS while the IRS is looking for the desk of a particular revenue officer to put it on. So they're going to finally get it to the desk of a revenue agent, and that could be weeks or months before it makes it to that revenue agent's desk. And once it's on that revenue agent's desk, they've got 400 just like it that they're going to have to work through before they get to yours. So in some situations, there is this emergency form called Form 911, where you can ask for an expedited release of a refund, in which case you have to go to the federal building in your area and provide evidence that you are not going to be able to feed your family and you're going to get kicked out of your house because you can't pay rent and that you're bearing undue hardship because of the delay. But that's the only thing you're really going to do to speed up 8862 other than sheer blind luck. So what does 8862 ask for? Well, it's asking for the year for which you are filing the form, because it's a year, there's no year on the form, so you need to enter the year in. Then it asks you to enter the number of days that each qualifying child for whom you are claiming the credit was living with you during the year. And it says if you entered less than 183 for any days, for any child, then obviously you can't claim earned income credit because 183 is more than half of 365. And of course 182 is less than half of 165. It also asks for the month and day of birth of each of the qualifying children. It asks for this address where the children live. It asks for other people who might be able to claim the children and where they live. All kinds of personal information, and the form actually has a second page that is not in here. The next thing we're going to talk about is due diligence requirements for paid tax preparers. So at the start of today's class, I said one of the reasons that the IRS has moved to a national registration program testing and CPE requirements for tax preparers is around this earned income credit. And they started taking a stab at the EIC due diligence rules a few years ago when they introduced a penalty for negligence on tax preparers. And beginning in 2011, that penalty has gone up. It was $100 per occurrence. It is now $500 per occurrence. IRS says that the fine is assessed against the preparer directly and not against the preparer's employer, although I'm sure they could find another reason to fine the employer. Each occurrence. So if you can show that there's a reckless, intentional disregard for the rules over time or gross negligence over a period of time, and they raid your office and ask to see your records on your clients, and they can see that you have not maintained records as you are required to, they can nail you $500 per offense. I actually think that's a rather light fine. Now, in Oregon, I believe the penalty for operating without a license is $5,000 per event. It's a much higher number here that you get snagged for operating outside of compliance with the law. And of course, Oregon can get you for other things to do with negligence. So to me, these seem like paltry little numbers. There's a question in our classroom, you know, here in this state we have licensing laws regulating the preparers, and can the supervisor be covered for that? The answer is both at the federal level and at the state level, at least in our state, there can be ramifications for a failure to supervise workers. Now at the federal level, we don't have any requirement that a preparer be supervised except a preparer who is not required to pass the test. So we have certain preparers who at the federal level are not going to be required to take that registered tax return preparer test because they are working under the supervision of a CPA, attorney, or enrolled agent who will sign the tax return for them, and because they are only entering information on the return and not making decisions about the information that they're entering on the return. So IRS says people in those situations are not supervised, and therefore the ramification would all come back on the signing preparer. But the IRS does have a general rule that a tax return, the responsibility for the accuracy of the return has to do with all of the people who had input on it. So if you have an office where you have a person who owns that office and they have 10 or 15 tax preparers working underneath them, they're ultimately indirectly responsible for those returns, and the IRS can come at the company. Now, I did watch a video of Karen Hawkins, who is the lady who is in charge of the Office of Professional Responsibility, OPR. OPR is the office that will be in charge of conducting an investigation on a tax preparer. And she said her preference is to find the firm. So that as long as she's running things, she's going to be putting the preference on finding the firm. Now, I don't know whether she was referring to EIC. I don't think she was. I think it was just a general thing. So you could be having problems with EIC. You could be having problems with all other kinds of negligence or incompetence within a firm, or outright fraud within a firm. And she's saying as long as she's in charge of OPR, which is only about another year or so, that her onus is on the firm and cleaning up the firm, because the preparers do what they're told, presumably within that firm, and that they're under the supervision of people who are telling them what to do. And so if you're operating out of compliance with the law, it's probably because your employer is either pushing you in that direction or ignoring it. So her opinion is that they should come after the firm. So whether you're in Oregon or anywhere at the federal level, they can look at the firm. It's my overall comment about Oregon is how steep the penalties are here compared to these little paltry ones at the federal level. So I think to have real kick, they probably should be higher, but this is where they're sitting right now. So due diligence procedures. Under IRS regulations, a tax preparer must not know or have reason to know that any information used in determining EIC eligibility or the amount of the earned income credit is incorrect. Paid preparers must also complete Form 8867, Paid Preparers Earned Income Credit Checklist, and also ask more questions if the information furnished by the taxpayer appears to be incorrect, inconsistent, or incomplete, and must not ignore the implications of information furnished or known. The inquiry is made and the responses must be documented, and the records have to be maintained for 3 years. Now, the IRS has basically a chart, a due diligence chart, for ensuring compliance with the EIC regulations. I've pasted it in your manual here, but this is the link that will take you to the horse's mouth if you want to read it there. And what the due diligence rules say is that for every client that you prepare a tax return, and on that tax return you enter the earned income credit, you have to complete the EIC eligibility checklist, Form 8867. And beginning with 2011 returns, that form has to be filed with the return. So you complete the form and you complete the checklist based on information provided by the taxpayer to the preparer. So you cannot be filling out an earned income credit claim for a taxpayer that you never talked to. That's essentially what it's saying. Someone just drops off W-2s for their girlfriend and says, yeah, can you please do her tax return for me? So you fill out the earned income credit and answer all the questions, except you never actually spoke to her. Or maybe you interviewed the boyfriend and asked him the questions. IRS says that's not allowed, that you need to interview the taxpayer, ask them the questions directly, and get answers from them. Now, I'll recount an example I can give you firsthand of how I have seen people try to abuse the earned income credit and try to get me or my staff to help them with it. Several years ago, there was a circuit of tax fraud experts circulating in the neighborhood of one or more of my offices, and they targeted at our offices and were sending their trained customers in to see us. Those customers, it became pretty clear who they were, because they were all coming in to have us work on tax returns that had very similar income and expense amounts. That was a very easy one to identify. When we interviewed the clients, I don't remember whether they seemed edgy or evasive at all, but what I remember is all of them were filing self-employment, and they were all reporting similar income, similar expenses that maxed out earned income credit. Another one that we saw was a little more subtle, but every bit as apparent. And this one involved a man who would arrive at our office and say, yes, I'm referring another client to you. And he'd come in like we should be so thrilled because he is referring us business. And of course, any good business owner is happy to have business referred to them. You're a happy customer and you send us a customer. Thank you very much. We appreciate that. But this one was not such a good one. And what was happening is he was making the appointment with the client. Yeah, I'm going to bring in so-and-so, and so he'd show up with so-and-so and sit down at the desk of the tax preparer, and as the tax preparer was conducting the interview, he would answer all the questions. And the client, who was there to get her tax return done, was strangely silent. And so we observed this for 1, 2, 3 times and decided that we didn't like it. So the next time he showed up with a client, my husband escorted him to the waiting area and asked him to wait out front and to allow the customer he'd brought in some privacy during the interview. And it was very interesting how all of the answers to every single question changed in the privacy of the interview. And for the remaining clients that he'd already come in with, we telephoned them and started to get a little bit different information over the phone as well. So pretty much it was obvious what was going on was he was out there looking for some people who probably were already filing tax returns, but in some cases not. I've seen situations where you might have a mom who's on welfare and she's got 3 kids at home, she's not working, and so she becomes a target because she's got these children who are not being claimed for earned income credit, and we've got people over here who are working but don't have children. Maybe we can just meld these together somehow and give these dependents over to these people who are working and give them earned income credit, and then because you let us use your kid, we're going to give you a share of that refund. Well, that is as fraudulent as fraud gets. If you wanted to describe fraud, that would be it. With this particular man, what I found interesting was that on one of the occasions where we asked him to sit out front and I interviewed the client, she actually was entitled to earned income credit all by herself. And what he was doing was giving her an extra child, an extra card, to boost her EIC up for 2 children over 1 child, and he was going to take a cut of that difference, and that was the deal that they had. But when I got her alone, without his influence in the room, she opened up and was honest, and with that we prepared a tax return for the 1 child she was entitled to claim. So you need to complete the checklist based on information provided by the taxpayer and not a spokesperson for the taxpayer. Computation of the credit. You have to keep the earned income credit worksheet or an equivalent that demonstrates how you computed the earned income credit. The next test is the knowledge test. The preparer must know the law. Oddly enough, the law says that paid tax preparers are required to know what the law is. And the preparer must not know or have reason to know that any of the information used in determining the taxpayer's eligibility for or the amount of the earned income credit is incorrect. Must not ignore the implications of information furnished or known, and must make reasonable inquiries if the information furnished or known appears to be incorrect, inconsistent, or incomplete. Record retention. You must retain Form 8867 and the EIC worksheet or its equivalent. That you must maintain the records of how and when the information used to complete these forms was obtained. That means obviously the date of the interview. And when it comes to earned income credit, I can never take enough notes, especially when I have mixed families like Jack and Sylvia. I'm asking, okay, who lives with you in your home? So let's just suppose I'm preparing only Sylvia's return, and Sylvia comes in and dumps a whole bunch of Social Security cards on the desk. And I see that she's earning $24,000. The questions I ask are, okay, Sylvia, these are children that lived with you during the year? Yes. And who else lived with you in your home? What do you mean? I mean, was it just you and your 4 children? Is there a total of 5 people living in your house? Or is there 6, 7, or 8 people in your house? I want to know who else lives there. Well, why do you need to know that? Well, unfortunately, the law requires that I make decisions about your entitlement to certain tax benefits, and to do that, I actually need to know all of the information that I can get. And one of the questions I have is, who lives with you? Well, how is that any of your business? Because the law says it's my business. I have to know it. Well, I just don't want to answer those questions. Then I can't do your taxes. Now, I've never had it get to a point where they refused to answer the questions, so I didn't do the return. But I've had it, like, why are you asking me so many questions? Boy, you're Snoopy. Yes, my middle name is Snoopy when I'm doing your tax return. Because believe me, if you get audited, my depth of interrogation will be nothing compared to the IRS auditors. And I've been in enough IRS audits to see the way they ask questions, and it's best off that you're asking these questions before the auditor is making a determination that you as a preparer was negligent for failure to answer them. Now, you must verify the identity of the person furnishing the information. If you're filing a return and this person says that you're preparing the return for them, you're supposed to see some method of proof. Picture ID is preferred. And then you have to retain records for 3 years after June 30th following the date the return or claim was presented for signature. We have the EIC eligibility checklist. This is essentially all of the questions that appear on that form 8867 for due diligence. And you can see that it's going in a yes or no format. Do you, your spouse, if filing jointly, and any qualifying child listed on the EIC each have a valid Social Security number? You have to answer yes, and if you answer no, well, you're done. The next question in line, is your filing status married, filing joint, head of household, qualifying widow, or single? Answer no if your filing status is married, filing separately. So you need to answer yes to that question again. Number 3, answer yes if you are not filing Form 2555. I am not filing 2555. Yes, that is a true statement. Number 4, is your investment income $31.50 or less? Yes, it is. Is your total income at least $1, earned income at least $1, but less than the amount shown here for your filing status and the number of qualifying individuals that you are claiming? It must be, and if it is, you check yes. And then it asks the same question, but regarding AGI, and it must be another yes. Number 7, answer yes if you and your spouse, if filing a joint return, do not meet the requirements to be a qualifying child of another person. That means I am not someone else's, yes, I am not someone else's qualifying child. Some of them are just written backwards. Then it says stop. If you have a child or children who you want to claim, answer questions 8, 9, 10, and 11, and skip 12, 13, and 14 for each child. But if you do not have a qualifying child, skip questions 8, 9, and 10, and 11, and answer 12, 13, and 14 instead. And then we're getting into when we're dealing with children. Does your child meet the age, relationship, residency, joint return tests? Is your child younger than you? Is your child filing a joint return? And is your child the qualifying child for more than one person? And it says check yes if your qualifying child meets the test. So it's basically going through these tiebreaker tests. Then we move on to tests that apply if you do not have a qualifying child. And they have to do, was your main home inside the United States for more than half the year? Are you filing a joint return? Or were you or your spouse, if filing a joint return, at least age 25 but not under age 65? So you can see this age one here. If you take this age question and pretend it belongs up here, that would cause problems. And I keep harping on that because I have had this happen too many times. Literally where a client will call me and say to me, your preparer told me I couldn't have the earned income credit because I'm 24 years old and that just didn't seem right to me. And I just wanted to call you and let you know about this conversation. And the first question I have is, well, did you have qualifying children? And they say yes. And then I say, you are absolutely right. My preparer blew it. And can it get any more embarrassing than that as an employer, that your customer knows more about the law than your preparer does? I think that that's as bad as it gets, frankly. I'm lucky she called. She'd give her free tax return for life for letting me know I had a preparer that was saying something that stupid. Now, but the problem is, it's happened more than once. From tax preparers I've taught, for tax preparers who've heard this speech. So I'm trying to get it cemented into you. All right, and then the final one, answer yes if you and your spouse of filing joint cannot be claimed as a dependent on anyone else's return. So the first thing I've done here is I'm just on the IRS's website, and I'm going to type EIC to show you how easy it is to find things. And even if you can't remember the link I'm giving you, it's enough to type EIC, and then it gives you recommended fields. And the first one is the EITC homepage. So we click on that. And then look at this. It has a link for tax professionals. So we click on that because that's what we are, right? And then it says EIC Toolkit for Tax Preparers. Visit our toolkit for tips on avoiding EITC errors, handling common due diligence situations, and finding marketing resources in this free online toolkit just for you. Click here for the toolkit. And it takes you to an external site, and there we are. Now, I spent some time on this site this year and found some videos that I thought were rather entertaining, and I think you can actually get CPE on this site as well. Yeah, this is an approved site for receiving CPE. Maybe I'd better go and get some CPE here, see what it's like. I do have to get CPE from somewhere other than myself for at least 50% of my hours, so I'm always looking for it. All right, so one of the links on here is Preparer Due Diligence, and also something called Due Diligence Video Clips. And during the tax season, I actually watched one of these and started to have my staff watch them as well. And it's a series of videos, and instead of listening to me, you get to watch actors. And this one is one I thought was quite funny. It's this blonde, ditzy hairdresser who comes in and wants to file unemployment to get her earned income credit, except she doesn't have any tax records, and what her poor tax preparer has to go through to actually be able to exercise due diligence. But what I find interesting in it is in this video, she tells him she has nothing, and he sends her on her way and tells her to make something, and she does, and IRS is considering that due diligence. So of course he's not telling her to make it up out of thin air. It has to be based on fact, but they are accepting that a lot of people may not know what they need to do to be able to prove their entitlement to the credit. And so this hairdresser is sent back as a self-employed person to put together journals, put together bank statements and any other records she has to verify that she actually had earned income from the work that she had. And there's a series of other videos in here. There's also a page that you can go to print things that you could hang up on your wall or maybe put on your desk for your clients. And one of those is the page that I had in your manual. I think it's this one. Let's see. No, that's another one. Not that one. One of these is the cutout I gave you. But it's a poster. Just finding it. Bookmarks. Stuffers or small flyers, stuffer, is it this one? There's something that you can basically put on your desk in front of your client. This is too many words. It's something without a lot of words that you can stick on the desk in front of you and show to your clients if they're starting to argue with you. Let's see. Oh, I've never seen this one before. Does your Social Security card look like this? Not valid for employment, not valid for earned income credit. Or does it look like this? Valid for work only with IRS authorization. If it says valid for work only with authorization, you can use the card to claim earned income credit if you otherwise qualify, if you were concerned about that. So at any rate, that page is just full of useful stuff, some of which you can print and hang on the wall. Yeah, and I'm just not sure where that one went that I wanted you to see. I liked it because it's basically a table that you can lay on the desk in front of your client, and it explains the basic rules for them. English and Spanish. 11 by 17. Now, somewhere on here is a poster that has something that lays out the rules in the 4 quadrants that you can point to your client and say, this is the test you flunk. Okay. So back to our manual, and we're going to move on to the next page, where at the top of the page it talks about the Advanced Earned Income Credit. The Advanced Earned Income Credit has been repealed for years after 2010. IRS says that less than 3% of the earned income credit population utilized Advanced EIC. Box 9 of the 2011 Form W-2 is grayed out. It's no longer possible to even put the Advanced EIC on there. My experience was in the early years when I first got into the industry, 20 years ago, I had a number of people who had Advanced Earned Income Credit. And as time went on, fewer and fewer people were applying for it, even though the Earned Income Credit was going up. And I don't know what the true scientific reason behind all of that was, but just my anecdotal reasoning by interviewing clients and seeing the reactions is they didn't like it when the Advanced Earned Income Credit reduced this year's refund. They like to get those big checks all at the end and not throughout the year. Financial management-wise, that may not be smartest, but practicality-wise, that's what customers like, is to get the big check all at one time. Additional Child Tax Credit is the next topic of the day. This is claimed on Form 1040, line 65. The Child Tax Credit is a non-refundable credit claimed higher up on the return. The Additional Child Tax Credit is a refundable credit. two names similar but very different meanings, very different rules about how you calculate them. For example, the child tax credit is related to the amount of income you have, but not the type of income you have. You can receive the child tax credit because you have a child under age 17 and your income falls within the parameters where you're not earning too much to qualify for the credit, and you still have tax. But there's no requirement that, for example, you have earned income to claim the child tax credit. You can have unearned income and get that credit. But with the additional child tax credit, you have to have earned income. Now, there are two different methods for calculating the amount of additional child tax credit that you can claim. If you qualify for both methods, you should use the method that gives you the largest credit. Firstly, we have rules for taxpayers who have one or more qualifying children. And to qualify for the additional child tax credit under this rule, you must meet all of these tests here. Number one, you have more than one. If you have one or more qualifying children for whom you can claim a dependency exemption. Number two, you have more than $3,000 of earned income credit, or of earned income rather. Now this $3,000 number is incredibly low. When the credit first came out back in about 1998, the income restriction was $10,000. You had to have at least $10,000 of earned income, and it was adjusted for inflation and kept going up each year. And then when Bush came into office, a couple of different measures were passed under him, and it was reduced down to, I think, around $7,000. And then when Obama came in and did his Economic Recovery Act, it got kicked down as low as $3,000. So again, we can see that if tax laws are not, or some tax breaks are not continued at the end of 2012, there's a lot of tax benefits that are going to be taken away, and one of the biggest is this one. So if you, in order to get it right now, you have to have $3,000 or more of earned income. Actually, it's more than $3,000 of earned income credit, and the calculation you do is based on subtracting $3,000 from your earned income, and then multiplying the difference by 15%. That's how you get the amount of additional child tax credit. Number three, you can owe no federal income tax. That is, the amount on Form 1040, line 55 is, well, zero. And number four, you complete and attach Form 8812 to your return. Now, even if your earned income was less than $3,000, you may still qualify for the additional child tax credit if you have 3 or more children. Now, this rule under this test, doesn't matter how much money you make. The additional child tax credit under this separate section has to do with how much you've paid in the form of Social Security and Medicare tax as a self-employed individual and as withholdings on your W-2. And you essentially can get that money refunded. It's entitling you to a refund of numbers that appear on your W-2, but you're only allowed to have a refund of withholdings on your W-2 from Social Security and Medicare if you have 3 or more children under the rules for this particular credit. So you have to have 3 or more children. You can owe no federal tax. You complete Part 2 of Form 8812, and you've paid in Social Security and Medicare tax. Now, how do you calculate the credit? Well, you have to complete Form 8812, and you can see the form is divided into 2 parts. In Part 1, we start off by entering the amount of earned income that we have, and then from that we subtract $3,000. So let's just suppose this formula is as simple as I say. My earned income for the year is $10,000. What's the formula to figure out the maximum possible additional child tax credit I can get? I'm going to take $10,000 and I'm going to subtract $3,000, and that leaves me with $7,000. And then what do? I multiply the $7,000 by 15%. Since I'm not terribly good with numbers sometimes, I'm going to use handy-dandy calculator, and I'm going to go 7,000 times 15%, and that's $1,050. Under that formula, the most additional child tax credit I can get is $1,050. But of course, my additional child tax credit cannot be more than the child tax credit per child minus any child tax credit I've claimed up top. So on the tax return on the 1040, if we go and take a look at a 1040 here, right here. So the way the additional child tax credit works is you look at the tax on line 44, you add in the tax on line 45, and you get a number on line 46. And then you go through and you start claiming all of your credits. One of the credits you claim is the credit, the child tax credit, this one right here on line 51. Now, in order for the child tax credit down here to kick in and help you, you essentially have to get this number down to 0, line 55. So that's what I say. You get your tax after credits down to 0. But because this number on line 54 is equal to the amount on line 46 and line 55 is 0, you've ended up in a situation on line 40 or 51 where you've not used up all of your child tax credit. Now, it could be a situation that if your only income for the year was $10,000 of wages, we could have a scenario like that. Let's suppose the number on line 38 is $10,000. It's the only income I have. And I've got me, and I'm claiming my child as a dependent. I've got my standard deduction. Let's just say I'm single. I'm claiming $5,800 as a standard deduction. I'm claiming 2 exemption deductions at $3,700 each. I'm already at 0 taxable income and 0 tax, aren't I? I'm going to have a big fat goose egg on line 46. And because of that, I get down to this child tax credit line, and it will be blank. But up here, I have $10,000 of earned income. So now I'm opening up the door to have entitlement to this additional child tax credit here on line 65. And the formula will be take my earned income, subtract $3,000, multiply the difference by 15%, and I'm going to take the lesser of that number or the unused child tax credit from up here. Well, the unused child tax credit for one child would be $1,000. And the formula I just gave you gave me $1,050, so my credit will be limited to the $1,000. Now let's suppose I have all of the same information, but I have 2 children. Now what would the credit be limited to? Not $2,000, because it can't be more than 15% of the amount by which my income exceeds $3,000. So that means that the credit would be limited to $1,050 if everything were the same, but I had 2 children. So you can see how that formula would change dramatically if we went back to the Clinton era rules where my earned income has to be $14,000. And under those Clinton era rules, I would get 0 additional child tax credit because the credit is a percentage of the amount by which my income exceeds $14,000, and well, $10,000 wouldn't do it, but it certainly exceeds $3,000, and $3,000 is a remarkably low number in the history of this credit. So it's only been a couple, 3 years. I guess we're in 2011, I think, is the 3rd year where we're doing a computation based on only 3,000. And presumably after 2012, it's going to shoot up again. So you can be in your manual. I'm going to throw up the answer key I created for Jack and Sylvia. It does not contain their tax return, but it contains all the numbers that could appear on potential tax returns based on the scenarios. In other words, I've filled out these tables here. So I've repeated the problem here, just so we can see the problem and the answers to it as we're going. And to just refresh you, we've got Jack, who is living with Sylvia as members of the same household. They lived together all year, and they paid more than half the cost of supporting each of the individuals listed. Jack's earned income and adjusted gross income is $23,000, and he paid 51% of the cost of keeping up the home. He received $200 of housing assistance each month last year and paid $500 for the after-school care of George. Sylvia's earned income and AGI are $24,000. She paid 49% of the cost of keeping up the home. She received $400 in food stamps each month and paid $2,500 of child care expenses for Becky. Let's talk about their situations. So what is the filing status of Jack? Well, the answer is we've given him head of household. He has paid more than half the cost of keeping up a household for a qualifying child. Who in here would be a qualifying child for Jack? George and Samantha. They're both his qualifying child. Now, this class is not about the definition of a qualifying child. So if you don't understand the definition of a qualifying child and the requirements for head of household, I mean, I could go and talk about that in a whole other session. But I did that a few weeks ago at the start of our series. Under the rules for qualifying child, your child must live with you for more than 6 months and meet the age relationship tests. And typically, if it passes all of those tests, you can claim this child as your qualifying child, which means you get to claim that child as your dependent. One of the fundamental rules about dependency is that the individual you claim as a dependent must either be a qualifying child or a qualifying relative. And one of the key important rules is that if the person you want to claim as a qualifying relative is the qualifying child of someone else, then you cannot claim them as a qualifying relative. So qualifying child rules always win out, And if an individual is both a qualifying relative and a qualifying child to you at the same time, you will claim their dependency as a qualifying child. So the question is, does Jack have a qualifying child? And the answer is yes, he does. He has two of them, George and Samantha. They lived with him all year, and he paid more than half the cost of keeping up a household in which they live. And what went on with Sylvia is not relevant. She did not pay more than half the cost of keeping up the house. He did. That's what I'm telling you in the problem. So he gets to be head of household because head of household does not ask who earned the most money. It asks who paid more than half the cost of keeping up the household. And I've just told you at the opening of the problem, it's Jack that did that. So facts to consider. Jack paid more than half the cost of keeping up a home for himself and a qualifying child. George and Samantha are his qualifying children. If Sylvia agrees to let Jack claim Becky, then Becky is also Jack's qualifying child. If we go back here and look at these relationships, we say Becky, age 3, is the child of both Jack and Sylvia. Well, under the rules for qualifying children, we get into tiebreaker. And if the child lives with both parents equally throughout the year, under the tiebreaker rules, the child goes to the person who had the highest income. So Sylvia wins Becky under the tiebreaker rules. But Sylvia could agree to let Jack claim Becky. So in that situation, Becky could also qualify Jack for head of household. But unless Sylvia agrees to let him claim Becky, he wouldn't be able to claim Becky. So what's the filing status of Sylvia? Well, the answer is single. She did not pay more than half the cost of keeping up the home. Therefore, she is single. And one of the questions I get from filers is, you mean I can claim earned income credit and have a dependent even though I'm not filing head of household? The answer is yes, you can. The only filing status that cannot claim earned income credit is married filing separate. So facts to consider for Sylvia. She has the highest income, but she did not pay more than half the cost of keeping up her home. Her children can qualify her for dependency exemptions, the child tax credit, and the earned income credit only. Which children could Sylvia be able to claim as dependents on her return? And the answer is Ben, Becky, and Jonathan. If their income was exactly the same, we would have a tie to beat all ties. The odds of that are infinitesimally small, but potential. I haven't had to go there. Points to consider. George and Samantha are Jack's qualifying children. George and Samantha could be Sylvia's qualifying relatives, except for the fact that a qualifying relative cannot be the qualifying child of another filer. So Sylvia cannot claim the children that are children of Jack, because to her they're qualifying relatives, and qualifying relative loses out to qualifying child. It's not even a choice. The qualifying child test automatically defaults to the person who has the qualifying child, and you cannot give a dependency exemption for a qualifying child to a person who can only claim that individual as a qualifying relative. So let me see. George and Samantha could not be Sylvia's qualifying relatives because they are the qualifying children of Jack. Jonathan is not related to either Sylvia or Jack. Therefore, his dependency exemption is claimed under the rules for qualifying relative, and he cannot be a qualifying child of either Jack or Sylvia. So what does that mean for Jonathan? His description on the dependency field of the front of the 1040 form is other. We would describe him as other because he's not related. And because he's not related, can he qualify either Jack or Sylvia for earned income credit? No. Can he qualify either of them for head of household? He lived with them, but was he related to them? No, he's not. His mother is. His mother is incarcerated. He is not. He's 16 years old. He's living with Jack and Sylvia because Sylvia and his incarcerated mother are best friends. So Sylvia very nicely is taking care of him. But is he a qualifying child to either Jack or Sylvia? The answer is no. And because he's not a qualifying child, he can't qualify either of them for earned income credit. He cannot qualify either of them for the child tax credit, because those demand that you have a qualifying child as a definition. Head of household, he wouldn't qualify them for that either. And the reason is that under head of household, the person who qualifies you for head of household must qualify you for head of household and be related to you. And that was another class entirely, but you could go back to that. Filing status and dependence is the name of the class where we talk about that particular rule. Number 4, which children could Jack be able to claim on his return? The answer is he could claim George, Samantha, Becky, and Jonathan. But points to consider are that Ben is Sylvia's qualifying child. Ben could qualify as Jack's qualifying relative, except for the fact that a qualifying relative cannot be the qualifying child of another filer. So if Sylvia did not live in the house, Sylvia's child, Ben, would be the qualifying relative of Jack. But because he is also the qualifying child of Sylvia, Jack is out of the picture, can't claim him at all. Jonathan is not related to either Jack or Sylvia, therefore his dependency exemption is claimed under the rules for qualifying relative, and he is not a qualifying child of either of them. Now let's look at this. Name the children Sylvia could claim for the child tax credit on her return, and the answer is Ben and Becky. Those are the two children that are her children. Points to consider, Ben and Becky are under age 17. They are Sylvia's qualifying children, and they meet all tests for the child tax credit. Jonathan could claim or could qualify as Sylvia's dependent under the qualifying relative rules, but he cannot qualify her for the child tax credit. Now name the children that Jack could claim. So this isn't a question about should he claim or will he claim, it's just is it potentially feasible that he could claim. And the answer is he could claim George, Samantha, and Becky for the child tax credit, but points to consider are George, Samantha, and Becky are all under age 17. They are all Jack's qualifying children, and they all meet the test for the child tax credit. But because Becky is also Sylvia's qualifying child, and Sylvia's income is higher than Jack's, Sylvia must release Becky's dependency to Jack if Jack wants to claim Becky. So she's going to have to voluntarily sign him over. And IRS recommends or does want that to be in writing. So I asked to see it in writing. Which children could Sylvia claim for EIC? The answer is Ben and Becky. Ben and Becky are both under age 19. They are Sylvia's qualifying children and meet the relationship, age, and residency tests for the Earned Income Credit. Since Jonathan is not related to either Sylvia or Jack, he cannot be a qualifying child of either of them. Thus, Jonathan could qualify as Sylvia's dependent under the qualifying relative rules, but does not qualify for her for Earned Income Credits. Now, who could Jack claim for Earned Income Credit? Well, the answer is George, Samantha, and Becky. Points to consider are that George, Samantha, and Becky are under age 19. They are Jack's qualifying children and meet the relationship, age, residency tests for the Earned Income Credit. Jonathan is not related, therefore he cannot qualify. Can Sylvia claim the Child Independent Care Credit? If yes, for which child? The answer is no, she cannot. Sylvia did not pay more than half the cost of keeping up her home. She cannot claim that credit. Can Jack claim the Child Independent Care Credit? The answer is yes for the child he paid dependent care expenses for, and that's George. So Jack can claim child care expenses he paid for the year, but Sylvia cannot. Now here's the problem number 11, and it's the one that exercises the brain a little bit, but it's really not that complicated to figure out what to put here. So let's take a look. Firstly, Jack's AGI across the board is a number that's fixed in stone. It's not going to change, nor is his standard deduction. Head of household is actually $8,500, not $8,400 there. That was last year's number. Exemption deduction is $3,700 for Jack and for each dependent claimed. And if he claims George and Samantha, that would be 3 times $3,700 for $11,100. If he claims George, Samantha, and Becky, it becomes $14,800. And if he claims George, Samantha, and Jonathan, it's the same $14,800. And if he adds on Jonathan, Samantha, Becky, and George, then he gets $18,500. So potentially, Jack could claim 4 of the 5 dependents, potentially. The question is, should he? So this is where the experiment comes in, because we start looking at the tax benefits associated with adding dependents, and we will see that in certain situations, there is a benefit for Jack to claim a dependent, and sometimes there makes no difference at all. So let's take a look firstly at if he claims only George and Samantha, what happens? Well, if he claims only George and Samantha, he has $23,000 of income. He subtracts out his standard deduction. He subtracts out the exemption deductions, and he's left with $3,650 of taxable income. The tax on that from the tax tables is a little bit shy of 10%, and it comes out at $343. He would be entitled to a child tax credit at a rate of 0.31 if we go look at the child tax credit table there. And 0.31 of 500 is $155, so we'll subtract that off his tax. And then he would obviously claim a child tax credit of $188 because $188 plus 155 equals 343, and his credits cannot be more than his tax. So that gives us tax after non-refundable credits of 0. And then we go to the earned income credit tables and look up his EIC. And we actually have the earned income credit tables at the back of your manual. If you were to flip through it, you would find the tables, and we will see that the earned income credit for 2 qualifying children is $37.78. And how much child tax credit does he get? We get $1,000 per child minus any child tax credit claimed up here. So 2,000 minus 188 is 1,812, and if we do the formula, which is 23,000 minus 3,000 times 15%, we're not going to be limited to less than 1,812 under that formula. So we take the 1,812, and this means that Jack has a refund of $5,590 even if he paid nothing in. That's what he's going to get based on claiming 2 children. What happens if he claims 3? George, Samantha, and Becky. Well, now his exemption deduction is $14,800. His taxable income is dropped to 0. He loses the benefit associated with the child care credit. It doesn't matter, he can't use it, it's gone. He doesn't claim any child tax credit. He doesn't need to there either. We go to the earned income credit tables and see that his EIC is jumped up to $44.17. His child tax credit has gone up by $1,000 because he's now claiming 3 children instead of 2. And we're left with a refund of $7,417. Now we can flip things over here and throw out Becky and replace her with Jonathan, but when we claim Jonathan, we're allowed to claim the higher exemption deduction up top, but the child tax credit and the earned income credit are going to be based on 2 children rather than 3. So Jonathan does save Jack money, but not nearly as much as if he claims Becky. Becky's a better deal. And you can see that under this scenario, his refund is only slightly higher than it is if he doesn't claim Jonathan at all. And in the final column, he claims everyone. And interestingly, when he claims everyone, his refund is no different than if he claimed only a few. He's claiming all 3 children. It should be the same. Oh, you can see I've got a typo, 4471 instead of 4417. You're right, I do have a typo. Which one is it? Yeah, we have to look at the earned income credit table. One of these is backwards. Okay, what are the possible tax return and potential refund scenarios for Sylvia? Actually, you know what? I'm pretty sure this is the right number, but we'll see. Potential refund scenarios for Sylvia. She could claim Ben, which is her child. Automatically, she's entitled to Ben, and Jack can't even enter into that realm. He's not allowed to claim Ben because Ben is Sylvia's qualifying child, but only a qualifying relative to Jack. So Jack loses, can't claim him. Then we've got Ben and Becky, because remember, Becky is the child of both Jack and Sylvia. And she could also claim Ben, Becky, and Jonathan. And what's going to be the best scenario for her? Well, under this equation, her income is higher than Jack's. Her standard deduction is lower because she's single. Her taxable income is going to be higher at $10,800, and she's claiming an exemption deduction for herself and Ben only in this first illustration. So when we do that, we end up with taxable income of $10,800 and tax of $1,199. She'll use up her child tax credit right up top there. She won't even get an additional child tax credit because she's used all of her child tax credit up right here. Her tax after non-refundable credits is $199. Her earned income credit would be $1,922 because of a single qualifying child, and her refund due to credits is $1,723. Well, let's see if we can improve on that situation and give her Ben and Becky. If we give her Ben and Becky, we've got the same income, the same standard deduction, but we're adding an exemption, and that reduces the taxable income to $7,100. If we do that, we get tax of $713. We also get a bigger earned income credit of $35.67, and the child tax credit is only $713 because it can't be more than the tax. So we end up with an additional child tax credit of $1,287, which is $2,000, $1,000 for each child, minus the child tax credit right here. That gives us $1,287. We add that to the EIC for 2 kids, and we get $4,854. Then we move on to the third scenario possible for Sylvia, which is to claim Ben, Becky, and Jonathan. And in this scenario, the only thing that changes is she adds one more exemption in. But the exemption helps her, because even after claiming that exemption, she still has taxable income of $3,400. The tax on that is $343. We claim the child tax credit of $343, And 2,000 minus 343 is going to give us 1,657 in this scenario. And she ends up with $3,500, the same $3,567 of earned income credit with a refund due to credits of $5,224. So now, what could Ben or what could Jack and Sylvia do to maximize the refund for their household? Getting married is the last thing they should do to improve the refund for their household. What would happen if they got married? Well, they might get a teeny weeny little bit of earned income credit because you can get earned income credit if your income is just under $50,000, and 24 plus 23 would take us to 47, right? They'd get an infinitesimal amount of earned income credit. The last thing they should do for tax purposes is get married. But there's some other legal things they could do to maximize their refunds, and that is decide who's going to claim these kids. Now, oddly enough, in the scenario I've given you here, the scenario that gives the biggest refund for this family is also the scenario that would happen under the tiebreaker rules. Under the tiebreaker rules, Sylvia wins Becky because her income is higher than Jack's. So even if they can't agree, Becky still would fall with Sylvia. And under the tiebreaker rules, Jonathan would fall to Sylvia because she also earns the most money. So under the tiebreaker rules, you've actually got Sylvia claiming Ben, Becky, and Jonathan. But Sylvia could agree to give Becky and Jonathan to Jack up top. That could happen. So what ultimately do we do? Ultimately, we do that scenario where we have these 3 dependents going to Sylvia, and we have these 2 dependents going to Jack. So Jack's refund is $5,590. Sylvia's is $5,224. But let's compare other possibilities. If Jack claimed George, Samantha, and Jonathan, his refund would be $5,778. That's a difference over this number here of only a small amount, not even $200 difference. So the benefit of him claiming Jonathan over not claiming Jonathan is a difference of less than $200. But what's the difference for Becky if she claims Jonathan? Yeah, it's a much bigger number, and the reason is her taxable income is higher, so she benefits fully from his exemption. Whereas not only does Jack not benefit fully from his exemption, he stops benefiting from the child care credit. So there's no child care credit that he can even begin to benefit from here. He doesn't need it if he claims Jonathan's exemption. So when you go through and study these, you'll get to a bottom line that says, based on all the facts and circumstances of this particular family, Jack should claim George and Samantha, Sylvia should claim Ben, Becky, and Jonathan. And when we do that scenario, we end up with the biggest refund coming to that family. I have given Jonathan to Sylvia. All those scenarios you see for Sylvia are the ones she's legally entitled to. There are no scenarios not listed for Sylvia that are legal scenarios. I mean, we could try giving Sylvia George, but she's not allowed to claim George because George is the qualifying child of Jack and only a qualifying relative to her. And the same rule goes with Ben. We can't give Ben to Jack because Ben is her qualifying child, but only a qualifying relative to Jack. So the adoption credit is a credit that was set to expire at the end of 2010. However, the Patient Protection and Affordable Care Act, also known as the Affordable Care Act, extended the credit through 2011 and made it refundable for 10 and 11. So at this point, unless it's been extended, it's gone. I think it'll come back. But right now it's not around. But for 2011, it is refundable. For 2010, it is refundable. You may qualify for the adoption credit if you adopted or attempted to adopt a child and paid qualified adoption expenses adopting the child. Rules apply as follows. The amount of the credit is as much as $13,360 per child in 2011. You can claim the credit even if the adoption does not become final. If you adopted a special needs child, you may qualify for the full amount of the adoption credit, even if you paid few or no adoption-related expenses. If you carried forward an adoption credit from 2005 or later because the credit was more than your tax, in 2010 you were eligible to claim a refund of all the collected child or adoption credit from those earlier years, but that refund was claimed on 2010. So if you have a client who had carry forwards in from 5 forward, you could go back and amend still at this point their 2010 return and claim a refund for any leftover credit. The maximum exclusion from income for benefits under your employer's adoption assistance program is set at $13,360. The adoption credit phases out when your income hits $185,210. It starts to phase out, and it's fully phased out when your income hits $225,210. So it's pretty generous income levels. Most of the clients that I work with who adopt children fall within those parameters. It wasn't that long ago that the income thresholds were significantly lower, and I was finding that people who could afford to adopt children earned too much for the credit. I found that regularly, but these thresholds are high enough that they work. Who is an eligible child? Well, an eligible child is a child under the age of 18 or who is physically or mentally incapable of self-care. You cannot claim the credit if you adopted your spouse's child. Qualified adoption expenses include any of the reasonable costs of adopting a child, such as court costs, attorney fees, traveling expenses, including amounts spent for meals and lodging while traveling away from home. So if you did a foreign adoption and you had to fly to China, which is one of the more common scenarios I run across, you're going to have all of the costs of traveling to China, plus all of the adoption agency fees that you're paying and the taxes, and whoever else knows what China charges, a lot of money. And those are all legitimate expenses because they are the ordinary and necessary costs of adopting that child. Expenses paid in an unsuccessful attempt to adopt a child before the finalization of an adoption of another child can also qualify for the credit. However, expenses connected with a foreign adoption only qualify if you actually adopt that foreign child. Qualified adoption expenses do not include the cost of adopting your spouse's child or for a surrogate parenting arrangement that violate state or federal law, or are paid using funds received from a federal, state, or local program, are paid or reimbursed by your employer or any other organization, or are allowed as a credit or deduction on a federal return. If you adopt a child with special needs, you can claim the adoption credit even if you had no expense. So what is a child with special needs? Well, your child is special needs if the following applies. Your adopted child must be a U.S. citizen or a resident of the United States at the time the adoption process began. A state, including the District of Columbia, has determined that the child cannot or should not be returned to his or her parent's home and probably will not be adopted unless adoption assistance is provided to the adoptive parents. Factors used by states to determine if a child is special needs can include the child's ethnic background, the age of the child, whether the child was the member of a minority or sibling group, and whether the child has a medical condition or physical or mental or emotional handicap. Now, you could be adopting a 1-year-old baby that appears to have autism, or you could be adopting a newborn that has fetal alcohol syndrome, right? The child could be desirable in every way other than that, and it may be that that alone is enough for the state to determine that that child is special needs. I've also had situations where a client was a member of a minority group and told me that she had adopted her niece. I said, why did you adopt your niece? Well, her mother's been put in prison. Okay, and I started thinking, well, this might qualify as a special needs adoption. And she said to me, my niece is not special needs. She doesn't have a disability, but I looked at the fact that the niece was a minority and that she wasn't a baby. That was enough. So I had her call the state, and the state said, yes, this was a special needs child. So that's an illustration of where the client may not know they have a special needs child, but you as the tax preparer can be making those determinations. Now, if the state has determined that the child is special needs, you have to get a copy of a written state determination and attach it to the return. How do you take the credit or exclusion? And actually when to take the credit or exclusion? You claim the credit in the following ways. Firstly, we look at, is the child a U.S. citizen or resident? If the child is a U.S. citizen or resident, then you look at when you pay the expenses. If you pay the expenses in any year before the year the adoption becomes final, then you claim the expenses in the year after the year of payment. If you pay the expenses in the year the adoption becomes final, you claim the expenses in the year the adoption becomes final. And if you pay the expenses in any year after the year the adoption becomes final, you claim them in the year of payment. If your employer pays your expenses for you, then you claim an exclusion in the year of the payment. That's the rules for children who are residents of citizens of the United States. But if you adopt a foreign child, the rules are a little different. If you pay the qualifying expenses in any year before the year the adoption becomes final, then you claim the credit in the year that the adoption becomes final. If you pay the expenses in the year the adoption becomes final, then you also claim them in the year that it becomes final. And if you pay expenses any year after the year the adoption becomes final, you claim them in the year of payment. There's also a note down here. It says if your employer makes a payment in a year before the adoption of a foreign child that is final, you include the amount in your income for that year. And then if in a later year the adoption is final, you claim the exclusion from income in that earlier year. How do you claim the credit? You fill out Form 8839, and I have an illustration for you. In 2001, Cindy Sometime finalized the adoption of her daughter, Sandy Sanders. The adoption was a special needs adoption. Cindy had no expenses for the adoption. She will file Form 8839 to claim the refundable credit, and she will file as head of household. Her W-2 is shown here. It's the only income she has, and it's $79,000. So let's take a look. We move over to the adoption credit form, and it asks you to enter the name of the child, and you can see there is room for more than one child. The question I've had more than once is it really $13,000 per child? And the answer is yes, it really is $13,000 per child, and there's room to enter the name of more than one child. I've had a client that did adopt two children in the same year. That's happened. I don't know about three, but potentially it's there. You've had one that's had three? Yeah, all special needs. Interesting. Okay. So the maximum amount of child adoption credit is entered on line 2. And the question is, did she have any expenses? And the answer is no, she had 0 expenses, but she's still going to enter the full $13,000. Because it's a special needs child, and she's checked the box right here to indicate that it's a special needs child. Then on line 7, she enters her modified adjusted gross income, and the purposes of the lines underneath that are to establish whether she's subject to a phase-out on the credit because her income is too high. The answer is no, she's not subject to a phase-out because her income is less than the phase-out, so she gets that credit in full. Documentation requirements for this particular credit. Because it is now refundable, you can imagine there's temptation for fraud. There's certainly an amount of scrutiny that the IRS is putting on it. Our experience has been for 2010 returns that it's taking some of our clients several months, 9-10 months in some cases, to have IRS clear them and send them their money. So if your client is nagging you because you filed the return in March and they still don't have it here in the month of May, they're going to be waiting a lot longer yet. Now, the IRS tells you the types of documentation to attach to the tax return, but no matter what you give them, they won't be happy. They won't be happy because they either lose the documentation or they decide since you gave them everything they asked for, they need more than that. But the types of things that they're going to ask for are receipts to prove you had qualified expenses, entry visas for foreign adoptions, final decree certificate or order of adoption, home study by an authorized placement agency, that's a qualifying expense, and they might want to see that you paid for it, child placement agreements or court orders, or a determination of special needs status by a state or the District of Columbia. They could ask for any or all of these items. And that is the end of the lecture. There's a couple of other classwork assignments in here, which I could have talked less and gone through these, but I think it's enough for you to read through these assignments on your own and review the answer keys for them. The first assignment involves Powder Blue and Cindy Blue, or Powder Blue and Sue Blue, who adopt two children, Sally and Cindy. This is a foreign adoption, and these are the expenses they paid for that foreign adoption. And you can, of course, open up the classwork answer key to see how their tax return works out. In the second assignment, we have another adoption, but this time of a special needs child for Linda Danvers, and it's predictable that her tax return is going to have a child adoption form looking very similar to the illustration I just showed you. Both of these have thrown in a Form 2441 to make you figure the child and dependent care credit.
Session 13 password number 3 is intruder, INTRUDER.
It is now time to complete classwork assignment number 1. Please flip to page 36 of the Session 13 Student Manual and take a look at it with me. There are 6 true and false questions to answer for classwork number 1, and I will do the first one for you. After that, you should push pause and do the rest on your own. Number 1, Janice's husband Harry was disabled and unable to care for himself for the entire year. Janice hired an attendant to care for her husband in their home while she was at work. Janice and Harry will file a joint return. They are eligible to claim the child and dependent care credit. Well, this is a true statement, and the reason that it's true is because that Janice is paying for the care of her husband to enable herself to go to work, and her husband is unable to care for himself. Now, it is also possible that the dependent care expense that Janice is paying for her husband could be claimed as an itemized deduction and as a medical expense on the Schedule A. Now, Janice cannot do both. She cannot claim both an itemized deduction for her medical expenses for the care of her husband and also claim a dependent care credit for those same expenses. So she would need to decide how she would like to proceed in that regard. But the basic truth of it is that this is a true statement. So at this point, please push pause on video playback and complete Classwork Assignment 1, questions 2 through 6. When you are ready, please resume video playback for a review of the answer key. And now let's take a look at the Session 1 Classwork answer key together, beginning with question number 2. Laura is single. She paid her 18-year-old son, Sam, to care for her younger children while she was at work. Laura will not be able to claim Sam as her dependent. Laura can claim the child and dependent care credit. True or false? Well, here is the answer to this one. The answer is false. Even though Sam is not her dependent, he is Laura's child and he is under age 19. Therefore, she cannot claim the credit for money she paid him because he was her child under the age of 19. Question 3, Jill is married to Jack. Jack left Jill and moved out of the home on May 1st. Jill worked and supported their 2 children, who are ages 8 and 10, for the remainder of the year. Jill worked all year and paid more than half the cost of maintaining her household. She paid before and after school care for her children while she was at work. She will not file a joint return with Jack. Jill can claim the dependent care credit, the child independent care credit. And the answer to that one is true. Jill meets the test for being considered unmarried for purposes of head of household filing status. Jill had earned income and paid child care for her children who were under age 13 so that she could go to work. She is also eligible to file as head of household. If she were not eligible for head of household, her only other option would be married filing separate or married filing joint. And then she could only claim child care if she were filing a joint return. But she meets all of the tests for being considered unmarried, and she will be able to file as head of household, and as such, she meets all tests for being able to claim the credit. Number 4, Betty and John are married. Betty worked all year. John was unemployed and looking for work for 2 months and a full-time student for 7 months. Their 2-year-old daughter was enrolled at preschool whenever John was at school or looking for work. Betty and John will be able to claim the child and dependent care credit on their joint return. This is another true statement, but I would like to pull you over to the answer key here because there are some calculations that have to go on. There is a limit for Betty and John and the amount of credit that they are allowed to claim. And the credit is going to be based on the amount of income he is deemed to have for the periods of time he wasn't actually working. And he needs to be able to show some level of income or the credit is 0. So when you complete Form 2441, you need to show how much income is allocable to the spouse who did not work. And that amount is based on a per child per month basis. The credit can be claimed for the months that John was either a student or out job hunting. And you must prorate the credit at a rate of $250 for each month that he was actually going to school or looking for work. So if John was a student for all 12 months, the allowable expense would be $3,000 per child. But since John was looking for work or was a student for only 9 out of 12 months, his allowable expense will be 9 months at $250 or $2,250 for the year. And they have only one child, therefore it is going to be a $3,000 limit for the year if he worked all 12 months, or $2,250 for the number of months that he was looking for work or was a full-time student. Number 5, Sally and Joe are married and both work full-time. Sally's mother, Winifred, lived with them and cares for their 5-year-old son. They pay Winifred to care for their son, and Winifred is not their dependent. Sally and Joe can claim the dependent care credit. This one is a true. All of the tests have been met. It is all right for the person who provides the child care to live with you as long as that person is not your child under age 19 or your dependent. And the mother, although she lives with them, is not a dependent, so she's fine. And clearly she's not under age 19. Number 6, Jackie is separated from her spouse, Tim. They did not live together at any time during the year. Tim pays child support to Jackie, and she has signed Form 8332 granting Tim the dependency exemption for their child. Jackie worked all year and paid daycare expenses for her 3-year-old child. Jackie can claim the child and dependent care credit. This is also a true statement. Jackie would have been entitled to claim the child as a dependent, except for the fact that she has released that dependency to the father. And the child is in the custody of one or both parents for more than half the year. And the parent with whom the child lives more than half the year and who has physical custody is Jackie. So even though she can't claim the child's dependency, she is able to claim the child independent care credit that she pays for him. So that concludes the Session 1 classwork. Let's move on. And the next classwork assignment we're looking at is classwork assignment number 2. Please turn to page 37 of your manual and take a look at it with me. This classwork assignment involves preparation of tax forms. You're going to be completing a 1040, a Schedule A, Form 2441, and Form 8839, which is the form used to claim the adoption credit. And in our problem, we have Powder and Sue Blue. Powder works as a manager and is married to Sue, who is a homemaker and also at the same time a full-time student at Ohio State University. Sue attended OSU all months of the year except June, July, and August, and she received a full scholarship and had no educational expenses. On June 1, 2011, the Blues finalized the foreign adoption of their daughters Sally Blue and Cindy Blue. The Blues incurred the following adoption expenses. For Sally, we have $13,000 paid in 2010 and another $7,000 paid in 2011. And for Cindy, we had $6,000 that was paid in 2010 and another $7,000 in 2011. During the year, the Blues paid for child care expenses, and we've provided you with the name and identification number of the child care provider and also the $8,000 amount that was paid for the care of Sally and Cindy while Powder and Sue went to school. The children attended the school from July through December for 6 months. The Blues live at 14 Tang Lane in Cincinnati. They paid $20,000 in mortgage interest, $4,500 for property taxes, and they had $1,000 of dividend income. Powder's 2011 W-2 is attached, and that represents their total earned income for the year. They will file a joint return. Go ahead and prepare the return. So here is the one and only W-2 from Aquariums or Us in Powder Blues name. Please push pause on video playback. Complete classwork assignment number 2 shown on pages 37 through 38 of your manual. And when you are finished, please resume video playback for a review of the answer key. And I have the classwork 2 answer key up on the screen in front of you for session 13. This classwork assignment, of course, involves preparation of Powder and Sue Blue's tax return. They have adopted 2 foreign children. A foreign adoption is eligible for the adoption credit, and when it comes time to evaluating the amount of qualifying expense and which year to claim it in, we've given you a bit of a puzzle that we expected you to figure out. That puzzle being that the expenses paid in 2010 cannot be claimed until the year the adoption becomes final. And since Powder and Sue finalized the adoption of their foreign children in 2011, both the 2010 and the 2011 expenses will qualify for the credit in 2011. And the total amount paid for the adoption of Sally was $20,000. The total amount paid for the adoption of Cindy is $13,000. Let's go take a look at the Form 8839. And on the form, we entered the name of the filers, Powder and Sue Blue, and the name of each child that was adopted. We entered the child's year of birth and the fact that this was a foreign child. So you will see that there is a box in column E that has been checked for each child. And then it asks, check if the adoption became final in 2011 or an earlier year, and it did, so the box is checked. Next, we enter the maximum adoption credit per child, and that's actually pre-printed on the form all the way across, and it's $13,360. On line 5, we enter the actual amount paid for the adoption of each child, and then on line 6, we take the lesser of line 2 or line 5, and you can see that we have done that. The next step on the form is to enter the income of the filers, and we've entered that at $180,000. That amount is less than $185,210, so there is no phase out that the Blues are subjected to. They're simply allowed to claim their credit in full, and you can see here that if we add those two credit amounts together, we get $26,360. That $26,360 will carry to their federal return, so let's take a look at it. And of course, on page 1 of the return, we've entered the filers, Powder and Sue. Their filing status is married filing joint. We've given exemptions, 2 for the Sue and Powder, 2 for Sally and Cindy. We've entered the W-2 for Powder and the dividend income that was received. That's where we get total income of $180,000. Moving on to page 2 of the form, we see that we have itemized deductions of $39,500, and we'll take a look at that Schedule A in just a moment. For now, I did want to draw your attention to the credit that we entered on line 71, $26,360. So let's go back now and take a look at the Schedule A. And on the Schedule A, we've entered $15,000 of state income tax withholding and $4,500 of real estate taxes paid. Their mortgage was $20,000. Their total itemized deductions are therefore $39,500. So we take the $39,500, subtract that out, enter 3,700 times 4 to get an exemption deduction of $14,800, and taxable income of $125,700. The tax on that amount for a married couple is $23,675, and then on line 48 we need to enter the credit for dependent care expenses, and that amount is $400. So let's take a look at the 2441 that we completed. As a note on Form 2441, before I show it to you, Sue Blue did not receive earned income during the year because she was a student and she didn't have a job. But she did attend school full-time, and as such, she can claim $250 per child for each month that she did attend school. She attended school the entire year. However, the children were enrolled in child care for only 4 of the months that Sue attended school. This means Sue can claim 4 months times $250 per child times 2 children, or $2,000. And here is the 2441. We enter the name of the child care provider and the amount paid, which was $8,000. We enter the amount paid for each child and each child's name, $4,000 per child. The maximum qualifying expense for 2 children is $6,000, but we're not going to be allowed to use $6,000 because we have to figure some limits. One of those limits is the income limit, and that limit is set at $2,000 for the income Sue is deemed to have been earning while she was at school. So we enter $2,000. We then look to the table for the income level of the filers. That's $180,000. That's well in excess of $43,000, and as such, they're going to be given a decimal amount of 0.20. So we enter 0.20 on line 8, multiply 2,000 by 0.20 or 20%, and we get $400. $400 is then entered on line 48. It is subtracted from the tax on line 46 and gives us tax on line 55 of $23,275. We then look to withholdings, which were $25,000, but we also have a credit from Form 8839, which I already showed you, $26,360. So the total amount of withholdings and credits that Powder and Sue Blue receive on line 72 is $51,360. And after we subtract out their net tax, they're actually left with a refund that is greater than the amount that they paid in. So that concludes the review of the Session 13 Classwork 2 assignment. Let's move on. And it's now time to complete classwork assignment number 3. Classwork assignment number 3 looks a heck of a lot like classwork assignment number 2. We've just changed the facts and circumstances a little bit to make you rework some numbers on some different forms. Linda Danvers is single and resides at 1212 Argo Way in Smallville, Kansas. She finalized the adoption of a special needs child named Zorel Danvers. And Zorel lived with Linda all year. Linda had no adoption expenses. Linda paid $8,000 for child care during the year to Super Tykes Daycare. And Linda is a homeowner. She paid $10,000 of mortgage interest and $3,000 in real estate taxes. Her W-2 is attached. Please prepare her federal return. Here is her W-2. You can see the income is $135,000 and Kansas withholding was $63.50. So at this point, please push pause on video playback and complete classwork assignment number 3. When you are ready, resume playback for a review of the answer key. And I have the Session 13 Classwork number 3 classwork assignment up on the screen in front of you now. Let's take a look at a few of the highlights. Zorel is Linda's qualifying child. She finalized that adoption in 2011 and he came to live with her. He is considered to live with her for the entire year from the point that she adopts him. And he will qualify her for the head of household filing status. Form 8839. Linda is eligible for the adoption credit even though she had no adoption expenses, and this is because Zorel is a special needs child. So we'll show you how to do that one. On Form 2441, the adoption of Zorel is finalized. He qualifies her for head of household, but he also qualifies her for the child and dependent care credit. She had qualifying expenses that she paid for him. However, her W-2 does show that she received $5,000 of dependent care benefits in Box 10, and you can see that right here. Box 10 shows $5,000. So you will need to complete the Form 2441, page 2 to show that reimbursed amount, and it will, of course, reduce her qualifying expense down to 0. And finally, on to the child tax credit. Zorel is a qualifying child for purposes of the child tax credit. However, Linda's income is much too high. She is completely phased out and is not eligible to claim the credit. So her allowable child tax credit is 0. Let's move on and take a look at her finished forms. Here we have Form 1040. Linda's filing status is head of household. She has one child named Zorel, and we've checked the child tax credit box. Her income from her W-2 is $135,000. Then on page 2, we enter her itemized deductions totaling $19,350, of which $3,000 is real estate tax on her house, $10,000 is mortgage interest on her house, and $63.50 is from the withholding on her W-2. She has 2 exemption deductions, one for herself and one for her son Zorel. Her taxable income is $108,250, and for head of household, the tax on that amount of income is $21,830. You will see that she has 0 allowable child and dependent care credit, and she has 0 child tax credit, so her net tax after credits is $21,830. She had $19,675 withheld on her W-2, and she has a $13,360 adoption credit. Even though she had no qualifying expense, she is going to get that credit anyway. So that increases her withholding and credit amount to $33,035. She has a refund of $11,205. Moving over to her Schedule A, we'll see that state withholding of $63.50, her real estate taxes of $3,000, and her mortgage interest of $10,000. On to the Form 2441, we need to show the name, address, identification number of the provider, and the amount paid to the provider. In Part 2, we enter the child's name, the child's identifying number, and the amount of qualified expense for the child, which of course cannot be more than $3,000 per child. On page 2 of the Form 2441, we enter the $5,000 as the amount showing in Box 10. Ultimately, it reduces her qualifying expenses down to 0. So we end up having an allowable amount on line 3 of 0 and a credit that is ultimately 0. On the Form 8839, we've checked that this is a special needs child and that the adoption became final in 2011. We're allowed the maximum amount of credit for that child for the year. There is no phased out based on Linda's income, so she is allowed that credit in full. So that concludes the review of the Classwork 3 answer key. At this time, let's take a look at the homework assignment for Session 13. There are 2 homework assignments for Session 13, and homework assignment number A starts on page 40 of your manual. You will need no forms for the completion of this assignment. You simply go through and answer the questions. All of the following individuals have earned income that is the same as their adjusted gross income. Use the attached tables to calculate the allowable earned income credit for each person. And we have a description of each person, the children that may or may not have lived with them, the amount of income that they have, and it's your job to use the tables at the end of this manual. And here they are, beginning on page 45, to determine the amount of earned income credit each of those filers is allowed to receive. Homework assignment number B involves preparation of a tax return for Jack Spratt. You're going to need to complete Form 1040 and 8812. Jack lives at 1666 Southeast Mother Goose Avenue. His wife Betty left him during the year. She left in the month of August, and he is stuck with the care of their 3 children. Your job is to prepare his tax return. He will not be filing a joint return with his wife. Homework assignment C assumes all of the same facts as for homework assignment B, except that in homework assignment number C, Jack has divorced. So his filing status choice will either be single or head of household, but not married filing separate. And your job will be to complete his tax return given that scenario. And the forms you will need to complete for homework assignment C are 1040 EIC and 8812. So that is the conclusion of Session 13 of the Basic Tax course. Have a good time preparing your assignments, and I'll see you next time.